Yeah. Good morning, friends. We have today in our online session, Mr. Chandra Reddy, who is a retired AGM from Canara Bank. He has a vast experience in advances. He has worked in even a HO in credit wing. So he is having rich experience in credit policy and other credit related matters. So he has agreed to take a session for us with regard to this credit policy and other topics. He is going to deal in the afternoon also. So I request all the participants to join the session, and you inform your other friends also, and continue to in the second session, afternoon session also, and get the best out of it. He has already shared the whatever material he is going to deal. It is available already in our CBOA website. So if you have not downloaded, you can now download if you want, or you can download later also. It will be useful for you because he is prepared with a very sincerely and very hard. I think he has taken all the sincere steps to cover all the circulars issued during the period. So thanks to you, sir, for joining with the CBOA, for taking this session.
Thank you very much.
To you, sir.
Thank you, sir. Thank you very much, sir. Good morning, participants. On behalf of Canara Bank Officers Association, I welcome all participants for this online session. Today, we will deal first this credit policy, and in afternoon session, we will go through some basal aspects, plus RBI notifications issued during 2022. Whatever RBI policy changes are there in 2022, those aspects are important for exam purpose. That also we will deal in the afternoon. And then regarding balance sheet items and how to answer that balance sheet questions, that also we will cover. This is briefly about today's program. First, since this credit policy is a very important one, entire morning session, I will try to complete this credit policy because so many questions will appear from credit policy. And apart from exam also, while dealing advances, this is most important one. That is why a little bit concentration, more concentration is required on this credit policy. It covers center. Since I am telling why this much importance, just briefly, I will tell you 2-3 minutes about this policy. The main duty of banker is accepting deposits and lending those deposits to public or needy people. This is our main duty and what we are doing, supposed to do. Suppose if you are accepting 100 crores deposit, entire 100 crores you cannot lend. So out of that, again, 4.5% you have to keep as CRR, where you are not getting any return, 0% return, and 18% you are keeping in the form of SLR. That is different types of government bonds, wherein you will get around 5 to 6% only return on those bonds. This is so 22.5%. It is statutory requirement we have to keep separate as per RBI directives. And the remaining out of 100 crores, 22.5 is already over. So 77.5 you can lend, where you will get some income in the form of interest, right? So 100 crores, whatever you have accepted, you have to pay back to the depositors with agreed rate of interest, whatever it is. समझ लीजिए average maybe 7% average, 6% average we are paying to our depositors. For example, we'll take for 1 year. After 1 year, you have to pay back to your depositors 106 crores with interest. Whereas asset side, you have converted these deposits as assets. As I told you, CRR, you are not getting anything. And SLR, as I told you, it is for SLR average bonds yield is around 5 to 6%. So 18 into 5 to 6, or you take another 1. And remaining 77.5 average yield, if you take 7 to 8% average, it may be around 6 crores you will get. Approximately we are calculating, not actually. So 6 crores plus 1 crores in bond, 7 crores you are getting. 107 crores approximately you are getting, whereas you have to pay back to the depositors approximately 106 crores or 105 crores. Suppose if you, whatever you have lent in advances, any advances failure is there. Normally accounts will become NPA. It is common, but we have to avoid. So if any advance becomes NPA, we will not get any interest on that NPA. So to that extent, we will not earn. समझ लीजिए in advances some 5% or 6% have become NPA and 1 or 2% you are getting less. That means instead of receiving from assets total 107 or 108, if you receive 105 or 104, you have to pay back to the depositors 105 or 106. So where is the shortage 1 crore? It will become problem. What Reserve Basel says, whatever the shortage is there in advances, whatever you are losing, don't pass on to your depositors. Depositors don't say that Baba hame loans mein thoda loss aa gaya, aap bhi thoda interest kam kijiye. If you say like that, it is a systemic risk. The entire system will collapse. So you should not tell like that. Basel says you keep some capital to take care of expected losses in the loan portfolio. This is what Basel account, of course, we will deal in the afternoon. Right? So any losses if you are incurring, these losses will be absorbed by capital. That is what in general. But our policy, what this credit policy says, why you have to incur losses? If you follow some strict guidelines, there are good chances are there to reduce the account becoming NPA, so that if account less number of accounts becomes NPA, minimize the NPA, so that you will get good interest. That interest will be taken care of, interest of depositors and also other expenditure, and we earn some profits also. So to minimize becoming NPAs, kam karna, risk, we call it as a risk. Becoming NPAs is a risk. और risk को कम करने के लिए Reserve Bank has given some guidelines. Basing on those guidelines and our internal experiences and feedback from circles, etc., our bank has come out with a credit policy, which is being updated every year basing on feedback received from other partners. Right? So what this policy is prescribing is minimizing NPAs and getting good profits. This is the intention of this policy. Okay, and again, what this Basel also says, you calculate risk in each loan portfolio and you calculate some expected losses. To minimize those or to take care of these expected losses, you maintain or you add premium to the rate of interest while lending. Or provisioning, you keep some provisioning out of your profits. So expected losses, whatever you are calculating by way of calculation of risk in that loan portfolio, those expected losses will be taken care by pricing a little higher than normal rate loans and provisioning, these two. समझ लीजिए beyond our calculations और थोड़ा loss आ गया. Some unexpected loss has come beyond expected losses. Those losses, to take care of those losses, bank has to maintain capital, which is taken care by Basel. This is briefly about credit policy, why it has come. So ultimately, if you minimize losses in credit portfolio, you will get good profits, which will be take care of depositors' interest and also our expenditure plus profits. This much importance is given to minimize risk in the loan portfolio. These all guidelines are given in our policy. This is the importance of credit policy. And this policy actually, so far they used to give only one, that is main policy. In main policy, part A consists of some broad guidelines adapted at higher level, at apex level, and the next operational procedures and guidelines at unit level or branch level. Now it is separately divided and separate guidelines they have given. What apex level they are supposed to do, like minimizing concentration risk. To minimize concentration risk, what bank has to do? or large exposure you have to reduce. That is what large exposure framework has come into the picture. And wherever some risk portfolios are there, like share market or commercial real estate, there also they have given certain guidelines to minimize. So that policy separately they have framed, and at unit level, what you are supposed to do, that also they have given separate circulars. Now, policy and strategies, in that again, they have divided trust areas, target markets, we are taking care. In target markets, again, trust areas and non-trust areas we have given. Trust areas means agriculture, SME sector, prior, etc., wherever we can lend without much restrictions. Restrictions का मतलब है ना, वो तो trust area में they help for economic growth and they help for individuals and society also. So such sectors which help for economic growth of the country, they says they are all trust areas. Other sectors, they also help for economic growth of the country, but not that much. That means in available funds, how you can segregate between fast developing areas and less developing areas, like that. So trust areas and non-trust areas, where bank has to give more trust, they are called as trust areas, like agriculture, industry sector, MSME, export and other segments, etc. Where you should not lend that much liberally, you lend, but with some restrictions, they are called as non-trust areas. Non-trust areas, 4 areas bank has identified. One is commercial real estate, the second one is non-banking finance companies, and the third one is capital market, and fourth one is industries which do not have growth potential. So this is briefly about trust areas and non-trust areas. Now we will concentrate first on trust areas. Trust areas may all priority sector advances mainly it will come. Already priority sector is covered or covering by somebody, so we will skip that priority sector for time being, and we go to other areas where others are to be covered. First one in this, we will go the definition of startup. Already it has appeared several times in the exam. Just briefly, we will go through what is a startup company. So any company incorporated from the date of 10 years, incorporated means birth, from the birth of the company for a period up to 10 years, whether it is a private limited company or partnership or LLP, whatever it is, up to 10 years from the date of starting or incorporation, wherein the turnover of the entity not exceeding 100 crores in any of the financial years. In all this financial year, out of previous 10 years, in किसी साल में भी उसका turnover 100 crores से ज़्यादा नहीं हुआ. In such cases, we call it a startup company, and which is working towards your innovation, development, improvement of product, processes, etc., etc. So this is startup company. 2 points you have to remember. 10 years from the date of incorporation is first one, and second one, in any financial year, its turnover is not exceeding 100 crores. We call it as a startup company, right? Next, priority sector, I told you, so many sectors are there. This we are not dealing now at present. We will skip and we will go through others. Qualifying asset, yeah. 5, 6, credit information, yeah. Now we come for other sectors. General information first we will go through. Yeah, credit information. Normally before financing, yeah, you need volume full, but not able to hear. It's clear. Okay, good. Yeah. Credit information. Normally before financing any loan, we take report from credit information companies, and 4 credit information companies at present, bank has got tie-up with them. That is TransUnion Civil, Experian Credit Information Company, Equifax Credit Information Services, and CRIF Highmark Credit Information Services. So 4 companies bank has tied up already, and here the scores they will give. Basing on these scores, we classify the borrower as a low risk borrower or normal risk or moderate risk or high risk borrower. Suppose if they score 750 and above in civil report, it is called as CS1 and it is low risk. borrower is classified as low risk. And in sanctions, there are no much restrictions for low risk. Similarly, 700 into 749 marks, if any borrower is securing, we call it as normal risk. There also no risk. In low risk, we may give some concessions. In normal risk, normally we will sanction. This is second one. And third one, between 650 to 699 marks, if anybody is scoring, we call them as moderate risk. It is CS3. Bank has considered moderate risk and better risk grade people as investment grade, where we can lend them. If anybody is rated as a high risk for big loans, it is CAC and above authorities only, they can sanction for new parties, high risk, right? Now, below 650 civil rating, if it comes, it is called as high risk. They're subject to next to higher authority sanction in small loans, right? Next one. And whether you have to take single report or more than one report from two companies. Here, a bank has prescribed again, in case of secured loans and personal segment, that is individual loans. So, housing loans, up to 10 lakhs, only one report is required, CAC, above 10 lakhs, two reports. Car loans, since it is also secured loan, 5 lakhs, up to 5 lakhs, it is only one CAC. Beyond 5 lakhs, two CACs are required. Education loans, up to 7.5 lakhs, one, and beyond 7.5 lakhs, two reports. And all other secured loans under personal segment, up to 5 lakhs, single, and beyond 5 lakhs, two reports. In case of MSME segment, secured loan up to 10 lakhs, only one CAC is required. Beyond 10 lakhs, two CACs. Similarly, agriculture also, up to 3 lakh rupees, one CAC, above 3 lakhs, two CACs. In all other loans, other than individual loans here. So, up to 10 lakhs, one CAC, above 10 lakhs, two CACs. This is regarding secured loans, how to take, how many CACs are required, create information reports. And regarding unsecured loans, here again in personal segment, personal loans up to 1 lakh only, because they are clean loans, up to 1 lakh only, single report, above 1 lakh, two reports are required. Educational loans up to 4 lakhs, since no security is required, there also single report, and above 4 lakhs, two reports. All other loans under personal segments up to 5 lakh rupees, single report, and above 5 lakhs, two reports are required. For gold loans, irrespective of quantum, only one CIR is required, right? In case of loans to non-individual firms, CIR from commercial segment is to be obtained, right? It is for non-individuals. Now, as I discussed earlier, below 650, if somebody is getting score in this report, credit information report, then who is sanctioning authority? Up to RO head CAC, next to higher authority. Above RO head CAC, respective CACs will sanction. Score less than 650. This is again a recalled question. Now, we are going for sector-wise. First one, real estate sector. Now, in real estate, we start even non-trust areas also. First, what is real estate sector? Real estate means creation of space or additional space on the vacant land or on existing construction. Suppose somebody is going to construct a house on vacant land. It is again on vacant land creation of space, or somebody is going for expansion. So that is additional creation of space. It is called as real estate. Real estate again, two types it is divided. One is non-commercial real estate. Second one is commercial real estate. Non-commercial real estate may all housing loans will come. And similarly, indirectly, we are financing to companies under for house construction to NBFCs, those who are identified by Housing Finance Corporation, HFC. So they are all comes under non-commercial real estate, and also construction of their own office premises. It is also non-commercial, and development of SEZs and acquisition of SEZs. These are all non-commercial. And commercial real estate, now non-trust areas we are coming. Commercial real estate definition, several times it has come in exam also. What is commercial real estate? It is also real estate only. That means we are giving loan for construction of or creation of additional space. Acquisition or construction or creation of additional space. wherein the repayment for the source of cash flows for repayment. That means from where the party is repaying our loan. So more than 50% of the cash flows towards repayment, generally they are from lease or rental payments or sale of the assets, and also recovery in case of default. Here I will tell you how. Suppose we are giving loan to a shopping complex. What this builder will do, he may retain some shops and collect rent, or he may sell some shops. So if he is collecting rent, keeping shops and collecting rent, then it is repayment is out of rental payment. Or if that fellow is selling of the shops, in such case, it is sale proceeds. So more than 50% of cash flows towards repayment are either lease or rental payments or sale of the assets. Then we call it as a commercial real estate. And after created one more in between commercial and non-commercial, commercial real estate residential housing, RH. This also asked several times in the exam. What is this RH, commercial real estate, CRE RH? Loans to builders or developers for residential housing projects, where it comprises some commercial space which does not exceed 10% of the total floor space index. Floor space index is nothing but total construction area in proportion to the space available, whatever it is, right? Here, that means a person is, say, one person is constructing apartments we are giving. What he says, sir, ground floor I am keeping some shops. There, if entire ground floor shops or schools, whatever they are starting, if it does not exceed 10%, then we call it as commercial real estate residential housing. Here some leverages it is given. Since commercial real estate in non-trust area, restrictions are there. Here that much restrictions are there, little bit liberalization is there. So this is the difference between commercial real estate and CRE RH. And there was a question about 3-4 years back in 3 to 4 exams they asked, bank has given a loan to a chartered accountant for construction of his own office. Where do you classify this? They have given options. One is commercial real estate, second one is non-commercial real estate, third one is CRE RH, fourth one is your housing, and fifth none of these as it is. So here you have to see the auditor or chartered accountant, he is constructing office for his own office. So what is the repayment here? Repayment is not rentals, repayment is not sale, so it is not coming under CRE. So since repayments are not coming out of sale or rentals, it is called as non-commercial. So here they have given that non-commercial option we have given. Suppose if you are giving to a chartered accountant for service sector, under service sector, we will classify it as a SME, it is separate box. Since they have not given an option as SME, it is non-commercial real estate, briefly, right? Then, since commercial real estate, I told you it is non-trust area, the restrictions here, we will see what are all. Banks are not permitted to extend fund-based or non-fund-based facilities to private builders for acquisition of land. Generally, exclusively for acquisition, sir, I want to purchase land. No question, we will not give. Suppose somebody has already purchased land, already. In such cases, we will consider that as margin and we will not fund for purchasing land. However, for individuals, while constructing houses, party says, sir, I want a housing loan. I will buy now one site and I will construct. In such cases, we will give for purchase of plot, provided party has to start construction within 18 months. We have to take undertaking from the party stating that I will construct the house within 18 months. Right? This is the guideline regarding open sites funding. Of course, our Canara site is there, separate scheme. It is there also, the guidelines are there separately. Next, some general guidelines regarding this given. Builders, they have to give some disclosures in the pamphlet. We have taken this project loan from so-and-so bank. It is under mortgage to so-and-so bank, because they don't, it is to protect the interest of buyers, home buyers. When the entire project itself is mortgaged to some bank, buyers should know that, so that they will take decision while buying, whether to pay directly to the bank or not, whatever those guidelines. So this is broad guidelines given in case of commercial real estate. Next, project parameters for commercial real estate. Generally, maximum exposure to a single project, it is not exceeding 500 crores. Our bank has restricted for single project under commercial real estate, maximum exposure we will give to parties on maximum 500 crores only, or 3.33 times of the tangible net worth of the borrower, whichever is lesser. This is restriction for single project. And debt equity ratio not more than 3:1. Promoters contribution is minimum 50%, because 50% party has to bring. Commercial real estate restrictions, it is a non-trust area, margin will be more only. Out of 50%, 25% minimum party has to bring, and remaining 25%, it may be advance from buyers, no issue. So minimum 25% he should bring equity. Again, that minimum 25% also, minimum 17% should be his own money equity, and remaining maximum 8% they may bring quasi equity, that is subordinated debt. They may take loan from outsiders for longer period. If they are subordinating, we consider it as a quasi equity. So their own money should be minimum 17% and quasi equity maximum 8%. Instead, party says no advance is received from any buyer. In such cases, entire 50% margin party has to bring. In such case, minimum 34% is his equity, his own funds, and maximum 16% is quasi equity. So this is restriction in case of real estate, commercial real estate. And remaining DSCR, it is on par with others only, 1.50 common and 1.25. Up to 1.25, it can be reduced by concerned sanctioning authority in case of need. And FACR is 2:1. 2:1. Why we are telling FACR is 2:1? Since we are giving 50% only for creation of assets. In any asset creation, mein आधा उसका है, आधा bank का. So it is 2:1. And the repayment period 3 years from DCCO in case of sale. As shopping complex example I told you, if shopping complex is constructed and selling, in such cases within 3 years from DCCO means the completion of operations, total date of commencement of commercial operations. That is completion, nothing but. So 3 years from DCCO in case of sale of property, and 7 years from DCCO if repayment is out of lease rentals. Suppose he is giving for rent, not selling, then up to 7 years we will give. However, maximum repayment should not exceed 10 years including moratorium. Next, now another 2 years back, bank has given another guideline. While lending to commercial real estate sector, apart from that real estate security, whatever you are taking, that is proposed project security, additionally, party has to give security not less than the loan amount. That is 100% of loan amount, party has to give collateral security in the form of residential commercial property. Residential commercial property, in addition to the primary security, is nothing but his project which is being constructed. So the distressed sale value of the collateral security should be not less than the loan amount. That is 100% collateral is required in this case, right? Next, loan to value, another one. This is a monitoring tool in case of all these construction activities, especially housing loans or this commercial real estate. Loan to value, LTV. Loan to value means total liability divided by value of security. That is loan to value. Liability, including your principal, interest, any charges, etc., that is numerator, and denominator is outside the available security. Suppose you are giving housing loan with 20% margin, that is 75 lakhs, we are prescribing 20% margin. For small loans, we are prescribing 10% margin. If it is a old house, 25% margin you are prescribing. If margin is 25% in case of housing loans, your LTV is accepting at 75%, because loan, suppose 20 lakhs is loan. 20 lakhs is house value, and you are giving 75%, since it is more than 10 years old. So for 20 lakhs, 75% means we will give 15 lakhs only. So 15 lakhs is loan amount and 20 lakhs is the value of security. 15 by 20, it is 75%. So at the time of accepting, you are accepting 75% LTV. So subsequently, this LTV should not grow more than 75%. What happens if it grows? समझ लीजिए 6 महीने के बाद your 15 lakhs has become 16 lakhs, whereas security is 20 lakhs only. That means LTV now 16 by 20, it is 80%. So 75 se बढ़ गया. Why it has grown from 75%? It indicates that there are no repayments in the loan. 15 lakhs, 16 lakhs बन गया तो repayments are not coming. So this is what, if LTV is growing more, means it is an adverse condition that either repayment are not coming or value of security may be deteriorating. Suppose loan he is repaying continuously. After 2 years, your liability has become 12 lakhs. Repayments are prompt, but security is also 12 lakhs or 15 lakhs. In such case, 12 lakh security, LTV is 100%. That means it is also adverse. So this is a monitoring tool, loan to value, liability divided by security. It should not be more than that accepted at the time of sanction. This is in case of real estate activities, important tool of monitoring. Next, no separate working capital limits. Working capital limit should be sublimit of term loan and a specific project specific. So that means for construction, this commercial real estate people, we will not give separate OD OCC. If at all OD OCC is required, total project loan we will sanction within 500 crores you are telling. Maybe in 500 crores project loan may we prescribe 1 crore as working capital limits within that project cost only, total project loan only, right? Next, here 2 guidelines are there. One is National Banking Code 2005 guidelines. It is applicable for 25 crores, exceeding 25 crores, this real estate activity, whether it is a housing project or your commercial real estate project, whatever it is, exceeding 25 crores loan amount, they have to follow National Building Code guidelines, NBC 2005. They have given this much space, they have to leave it for some, so many guidelines are there, right? And the next one, 1 crore and above loans ke liye, National Disaster Management Authority guidelines. Here also they will ensure that party is constructing as per given plan only by leaving a required space like that. National Disaster Management Authority guidelines. So 1 crore and above NDMA guidelines, above 25 crores, it is NBC 2005 guidelines. This is briefly about your commercial real estate. First one in our non-thrust area. Then we go for capital market. Second non-thrust area, capital market exposure. Yeah, somebody is asking DSCR and FACR and their impact. Certainly, I will tell you. Anyway, afternoon I am trying to touch this balance sheet. DSCR, FACR, both I will tell you. Okay, DSCR for repayment towards term loan repayment, we will take 1.5 as it is, I told you. FACR, fixed assets coverage ratio, for our policy, it is 1.33. That also I will discuss. It will come in our term loans. I will discuss at the time of term loans. Sure. Right. Capital market. Maximum exposure by bank, either solo basis or consolidated basis, to not to exceed 40%. That means whatever loans we are giving to capital market में किस किस को देते हैं? Loans against shares we will give, and stock and share brokers also we will give, and we may accept collateral security of these shares also. And apart from that, individuals, of course, for non-individuals, we will not give loan against shares. We will give to non-individuals against shares. And for in case of firms loans, we will accept them as collateral security. Apart from this, bank may also directly invest in shares or bonds, that is convertible bonds or venture capital funds, etc. So total exposure to capital market not to exceed 40% of bank's net worth. It is general guideline, prudential guideline, and within that 40% may our direct investment in shares should not exceed 20% of bank's net worth. So here not capital, it is total net worth we have to take. So total exposure to capital market, maximum 40% of our net worth, our direct investment in shares, etc., not less than 20%, maximum 20% of net worth. These two guidelines. Next, normally while extending loans to this share and stock brokers activities, minimum margin 50% we will prescribe. Even for similarly earlier for loan against loan, the shares also for giving loans, we say physical 50% margin in case of physical scrips and 25% in case of demat. But anyway, now physical scrips are not there, only 25% margin there while giving to individuals. Right? Now, here for giving firms against security also, 50% margin, share and stock brokers only we will give against primary security of shares apart from individuals. So their margin is minimum 50%, either for OD or for CDB, that is check discounting facility. And 20% margin in case of intraday ad hoc over limit. Same day operations will be there if account is exceeding intraday ad hoc limit. So there also 20% margin we will prescribe against shares. This is for share and stock brokers. And moreover, for share and stock brokers also, we will give them for their share broking business activity only, not for buying shares and keeping. So this is another one, right? And for other businesses, no loans against primary security of shares and debentures, they can be accepted as collateral security. This also we have discussed just now. And apart from this, for share and stock brokers, we can sanction limit against security of land and building also there, landed properties. But their 40% margin we will prescribe for share and stock brokers against landed security also we will give, right? Next, margin on advances or issue of guarantees against shares or units of mutual funds. Here also, suppose if you are giving any BGs, bank guarantees, there also 50% margin and 25% if shares are in demat form. Already we have discussed this, sir. In case of BGs for capital market operations, minimum cash margin 25% is prescribed within total. So total margin anyway party has to bring 50%. Out of that, minimum cash margin means his own amount. Minimum 25% should be there. Right? Remaining 25% he may give in other forms. Next, advances against units of mutual funds. Units of mutual funds. Normally, against units of mutual funds, if it is a equity, say linked savings, we will not fund. Whatever that lock-in period is there, that also they have to complete. Then only we will consider. But the value, while fixing limit, the value we consider is net asset value or repurchase price or market value. Net asset value, total fund value divided by number of units. That is net asset value. Or repurchase price, it will be available in our, every day it will be coming in our press. Repurchase price and market price, both will come. So out of whichever is less, that we will take as a value of that mutual fund and fund against that, keeping our margin as usual. Loans to mutual funds. This is mutual fund companies also we will sanction for their temporary mismatches, but maximum period of 6 months and within ceiling of 20% of their net asset of the scheme. Particular scheme में total net asset value कितना है, उसमें 20% maximum we will give and maximum period of 6 months. This is briefly about our capital market का. So 2 non-trust areas are over. Third non-trust area, lending to non-banking finance companies, NBFCs. Normally, for financing to NBFCs, the main condition we accept is somebody is inquiry में आ गया that loans giving to share brokers not for speculative purposes. That means not for purchasing shares and keeping idle. As I told you, it is purely for business purpose. Okay. Next one, lending to NBFCs. They are to be statutorily registered with the Reserve Bank of India, then only we will give. But earlier days, we might have given unregistered NBFCs also. Now bank says, if any outstanding loans are there, such loans, you bring them to less than 2 crores limit. So now there is no question of direct lending, fresh lending to non-registered one. Now all should be statutorily registered with RBI, the first one. So here the broad guideline for this NBFCs is, generally we finance for asset finance companies. That means any NBFC, it is giving loans to public or somebody, a business, etc., just like banks. This is also, they are also doing. These NBFCs should create at least 50% assets, physical assets. Then we call them as asset finance companies. That is guideline general. 50% is minimum level. But bank has prescribed, if you want to finance asset finance companies, minimum 60% of their assets should be in the form of physical assets. Physical assets may be tractors, somebody purchase tractors or vehicles and give it on lease, etc. So 60% of their loan should be given for creation of physical assets. And 60% of their income also coming from these physical assets. Then only we call it as asset finance company. So, but minimum criteria is 50% only. But now we have prescribed minimum should be 60% as per our guidelines. As against base is 50, right? Next one, infrastructure companies. Infrastructure company means these NBFCs, they have started to fund only infrastructure companies. But sometimes some loans they may give beyond infrastructure, other sectors also. That is why whom we call as infrastructure companies, a NBFC which deploys at least 75% of its assets in infrastructure loans. So 75% of its loans are for infrastructure loans, means long-term, very long-term loans, maybe 15 years, 20 years repayment like that. And it has a minimum net owned funds of 300 crores. It has minimum credit rating of A or equivalent, then only we will give, otherwise we don't give to the NBFC. And its capital to risk weighted assets ratio is 15%. The capital ratio should be 15%. So these are conditions. One is net owned funds 300 crores. Generally for NBFCs, what we say is 100 crores is sufficient. But for infrastructure companies, it is 300 crores it is prescribed. And CRAR, credit capital ratio 15%. 75% of its assets should be infrastructure loans. This is for IFC companies. Next, systematically important core investment company. Last year they gave this question in exam. I think 2 to 3 or 3 to 4. What is the systematically important core investment company means? This is a holding company. They simply buy shares of their own sister concerns, group concerns. They don't buy shares of other companies, or they invest only in sister concerns or group companies. They don't invest in other companies. So it is purely meant for investing or buying shares of their sister concerns or group companies. It is a holding company. For that NBFC, we call it as a systematically important core investment company. So here the condition is 90% of its assets are investments or equity shares of sister concerns, group companies. So 90% they should invest in group companies only, and the asset size is 100 crore or above. Total asset size, right? Next, IDF, Infrastructure Debt Fund. This is about 4 or 5 years back. It is created Infrastructure Debt Fund. What is this infrastructure debt? The main intention is to credit flow to infrastructure again. Just like earlier we have seen infrastructure company where the 300 crores and 75% of its loan to infrastructure. That is one type of NBFC. This is separate fund, infrastructure development fund, separately created by one NBFC. It is called as IDFC NBFC. But here what they do, they collect public money by issuing rupee, dollar or denominated bonds, either in rupee or dollar denominated, with minimum maturity of 5 years. That means they collect funds from public by issuing bonds, and that funds they will deploy to infrastructure development. So this is idea. Next one, NBFC, microfinance institutions, MFIs. Microfinance institutions already giving loans to self-help groups, individually or groups, whatever it is. We have seen this. And earlier condition was they should possess 85% of assets as qualifying assets. Recently, Reserve Bank has reduced this 85% to 75%. So this NBFC microfinance institution, they should possess at least 75% of their assets as qualifying assets. Again, they have given qualifying assets. There also income criteria they have changed. Earlier 1.25 and 2 lakhs they have given rural areas and urban areas. Now they say uniformly 3 lakh rupees is income criteria for giving loans to poor people under this microfinance. Income criteria is 3 lakhs. These two changes they have made. Remaining all same qualifying assets they are continuing. Right? Next one, NBFC factors. So NBFC factors, what they will do factoring? Factoring is nothing but purchasing book debts. If they purchase book debts of local, that means in India, they call as factors. If any factoring activity in NBFC purchases book debts of abroad, receivables of abroad, then we call it as forfeiting. Forfeiting is a long term, factoring is a short term. Factoring means local debts, inland debts only, it will discount. So we are also financing OD OCC against book debts we are giving. Then why this NBFC factors? So what we are doing is, normally for book debts, we prescribe margin of 30 to 40% margin we prescribe in banks. Whereas this NBFC factors, they are exclusively doing that activity only, factoring, that is purchasing book debts and maintaining book debts and the collection of book debts, etc. It is exclusive their duty. That is why what they do is they give more finance. That means up to 80% or 90% also they give finance against book debts, whereas banks will not do. So that is why this factoring activity is also going simultaneously. So we are also funding to factoring company because they also want finance. So where we will finance, it is a non-deposit taking. So they want funds. There we will give NBFC. Their principal business is factoring, and at least 50% of its assets and income are factoring activity only. So here also, out of the total lending, at least 50% are purchasing of book debts minimum. And out of the total income, 50% is from book debt finance. In such case only, we will finance this factoring activities. Next, mortgage guarantee companies. This also has come about 2-3 years back. Mortgage guarantee companies, at least 90% of their business turnover is mortgage guarantee business, or at least 90% of the gross income is from mortgage guarantee business, and net own funds is 100 crores. So here 90% now. Earlier we have seen 60, we have seen 75, we have seen here it is 90% of the business is mortgage guarantee business. Such cases we will give. So this is briefly about NBFCs, and we have completed this non-trust areas, 3 areas. Fourth one I told you, industries which do not have any growth potential. We call it as sunset industries. Since sunset industries, they do not have any future growth, we will not finance general bus. Next, some other guidelines we have given. This is not a non-trust area. This is general guidelines. One is lending to software. This is also last year recalled question is made. The margin on computer hardware as well as fixtures and interiors, wherever applicable, shall be 40 to 50%. Why this margin is more for computer hardware? Frequently, it will become obsolete. For very fast changing one. Today's technology, tomorrow it will change. So that is why margin we keep as higher margin. Party has to bring higher amount, 40 to 50%. But this 40 to 50% margin can be reduced to 25 to 30%, where in some cases, where vendors will have agreement. What is that agreement? Anyway, frequently the technology is being changed. Whenever technology is changing, we will also upgrade your machinery to latest technology. If such conditions, such agreement is there, in such cases, margin can be reduced to 25 to 30%. And the term loan repayment normally 3 to 4 years we will give maximum. Otherwise, normally our term loans, I will tell you in our policy, again further it is there, up to 15 years also we will give for term loans. But here 3 to 4 years only term loans repayment. Next, for producers of feature films, very rare question. Feature film producers also we will finance. Here 3 conditions. One is he should have at least 5 years experience. Second one is he is not a defaulter with NFDC, that is Film Development Corporation Code. He is not a defaulter, second one. And third one, our loan is only 35%. Remaining 65% margin, out of 65%, 25% is his own money, and 40% advance from distributors, film distributors, they will give advance. So that will become 40%. So total 65% is margin. Bus. Next, bill discounting. Generally, bill discounting is also part of our working capital finance. And some finance we will give as OCC, some bill discounting basing on needs of the borrower. But here the condition is borrowers, corporates and other constituents having sales turnover of 50 crore. Sales turnover here, not limit. Turnover of 50 crore, they shall disclose aging schedule of their overdues. That means over debtors, how many days outstanding debtor, this fellow kitne din se hame paisa dena, that they have to give aging schedule in their periodical returns or statements submitted to the bank. This is the condition, right? Next, bills discounted under LC. BULC is treated as exposure on the LC issuing bank. It treated if that LC is issued by other bank. Suppose somebody is bringing other bank LC, we are discounting bills. If party is not paying, other bank will pay. So it is exposure of other bank, exposure on other bank, right? Next one, 3 schemes are there. One question it has come again last year, STCL and corporate loan scheme. Short-term corporate loan scheme, STCL. Well, generally what for this business we will give loans, we are telling purpose. Here, since it is a short-term nature, short-term mismatches. Suppose party, some loan is sanctioned to the party, other loan, maybe some long-term loan from some other institutions, etc. It takes some time. By the meantime, some machinery has come, our party has to meet some working capital, good corporates. So such corporates, we will give short-term corporate loan scheme. It is for short-term. That's the name itself is indicating. Only to parties with good track record and no overdues. Existing parties also will give, new parties also will give, but with good track record and no overdues. Next, maximum within a prudential cap of 20% of our unimpaired capital funds. So here under short-term corporate loan scheme, maximum how much we can give is, maximum is 20% of our capital funds, total exposure under this particular scheme. इसमें two types are there, STCL में. First one is secured STCL. That means we are accepting some security and giving loans. That is secured STCL. The maximum tenure is 12 months for this. That means we will give loan for 12 months, but at a time 12 months we will not give. First we will give up to 6 months and then roll over by another 6 months. So total period should not exceed 6 months. And whatever you are sanctioning, it should be availed within 3 months from sanction it is given. Again, subsequently, it is mentioned in our policy as STCLs are to be availed within 30 days. So now it is not 3 months, it is 30 days. Earlier norm was 3 months. So I have mentioned as it is in policy at present, but subsequently it will come, tenability may, it is now, it is 12 months, 1 month only. Within 1 month, they have to avail. Next one. Second is unsecured STCLs. Unsecured STCLs, generally we will give for government companies or public sector undertakings only, not for others, because it is unsecured and big quantum of loan. So here maximum tenor is 6 months only. The loan sanction shall have to be availed within a maximum period of 30 days here from the date of sanction and not more than 2 tranches, means maximum 2 disbursements. It will be there. This is about unsecured. So secured 12 months, unsecured is 6 months. Third one is corporate loan scheme. This is also similar to above one only, but here maximum term we will give 60 months. That is only difference. So first one secured 12 months, unsecured it is 6 months, corporate loan scheme 60 months repayment. Bas. Next one we will go. Consortium advances. Consortium advances. More than one bank financing by forming a consortium. We call a consortium. Still we will discuss in further also it will come. So the condition here in consortium advances, our participation should be minimum 10%. But again, of the fund-based limits. Minimum 10% of the fund-based limits. Sometimes other banks, what they will do, suppose party is requiring some 1,000 crores. In 1,000 crores, what they say is, the lead bank, it will tell 500 crores, they want a fund-based limit, and the 500 crores, they want non-fund-based limit. We take that 500 crores and other banks, you finance non-fund-based only. We will not accept that. Whatever fund-based limits are there, within the 10%, they should pass on to us. Then we will accept it. This is the condition for consortium advances. In remaining guidelines, we will see. It will also come. NOC, etc. I will discuss. Next one, multiple banking arrangement. Here, multiple banking arrangement, very frequently asking about pari passu charge for 1 to 2 people. Here, multiple banking arrangement में pari passu charge over security hypothecated shall be obtained. Multiple banking, what is this? Consortium में all bank, one leader will be there, other member banks will be there, they will be continuing common documentation, whatever they say, it is common, applicable to all. Whereas in MBA, it is separate. Each bank will have their own terms and conditions. Each bank will have their own rate of interest or security, whatever it is. But whenever they are sharing, common security is there, they have to share on pari passu basis. Pari passu basis means in proportion to the loan account. Suppose 100 crores security. Bank A has given 20 crores, Bank B 30 crores, Bank C 30 crores it is given. Security is 100 crores and our loan is 100 crores. So Bank A will get 20% right on the security. Similarly, Bank B 30% and Bank C 50% will get. So in proportion to their loan amount, they will get share. That is called pari passu charge. Next one, quarterly exchange of information among financing banks. This is a must. We don't know that party is availing in with other bank how much amount. So all that information will be available here. Apart from this, half-yearly chartered accountant compliance regarding statutory guidelines. RBI is giving the exchange of information and some disclosures see how to do. There are no dues, etc. It is called CDD certificate again. Government dues nahi hai, workers dues nahi hai. Like that, they have to give all these declarations. For the chartered accountant will give certificate. That certificate, CA certificate, it is half yearly they have to give. And apart from this, whenever party is approaching for either renewal or enhancement, in this, party has to submit audited statement containing what are all the loans availed from other banks also. One quarterly exchange of information, it will be there. Apart from that, whenever party is approaching for either higher limits or for renewal, he has to submit a chartered accountant certificate regarding exposure with other banks. This is about multiple banking arrangement, MBA. Third one is JLA, joint lending arrangement. About 7-8 years back it has come, and from that point onwards they are asking questions continuously. What is the JLA? Wherever a party is enjoying, single borrower enjoying 150 crores and above from more than one public sector bank. In such cases, earlier we have seen MBA, suppose a party is enjoying 200 crores with 3-4 banks. In such cases, what Reserve Bank says, compulsorily you form JLA, joint lending arrangement. So this is almost similar to consortium but separate. Here they have given 150 crores and above, if anybody is enjoying, JLA formation is mandatory. Suppose he is not a good rated company, in such cases lesser amount also JLA is to be formed. This is RBI guideline. Only point here is cut-off limit, bus. One. Next one. Time frame for issuance of NOC or pari passu letters and seeding of charge in respect of consortium or MBA. This at higher level 2 to 3 and 3 to 4 they are touching this question every year. Last year there was days separately they have given, but now it is very simplified they have done. What is the simplification? While granting additional facilities by existing bank or new bank in consortium or MBA, they should communicate and complete the NOC process before disbursement. First, what party says, yes, I am going for some additional loan. He will give information to other bank. From their consent, whatever it is coming, consent or rejection, whatever it is, before disbursement, he has to obtain NOC. This is general guideline. One. Now, days I will come. Lead bank in consortium or bank with the highest share in MBA. What they will do? Suppose borrower says, sir, I want additional limits. I am taking from other bank. Say, for example, say some other bank I am inducting in this. So they are ready to give amount. That bank, before taking NOC, they should not disburse. Sometimes they may sanction, doesn't matter, but they should not disburse. That is the condition. But for that, bank has given, the RBI has prescribed days. What is this says? First party will give notice. I want to take loan from so and so party, additional amount. Or if anybody is willing to sanction me, okay, I will take from you only. Nobody is willing, okay, if somebody is giving, I am taking from that bank. First, he will submit letter to lead bank and other member banks. I intend to take loan. Then within 15 days, lead bank has to call for meeting with the other member banks. And in that meeting, they will decide whether to give NOC or not. So 15 days time is taken for taking decision, whether to give NOC or not. If they don't want to give NOC, within 15 days, rejection. Yes, we don't want to give NOC. So for rejection, 15 days. First 15 days for taking whether to give or not, number one. Suppose lead bank and other bankers has acted, yes, we will give. Then what lead bank will say is, I will send a proposal to my head office and take permission. For that, it takes 30 days. So lead bank will take for total permission 15 days for notice for conducting meeting and 30 days for getting approval from lead bank. So 45 days ho gaya. For lead bank, maximum period is 45 days. This is one question. Second one, lead bank has already sanctioned. So they will give, this is our sanction memorandum. Basing on that, you go and approach your banks and get sanction for NOC. So other banks will take, member banks, another 30 days to get permission from the competent authorities. So here another 30 days has come. Lead bank 45 days has taken, member bank has taken another 30 days. So 75 days, 45 plus 30, 75 days. So for member banks, it is 75 days to complete the process of seeding pari passu, NOC giving and seeding pari passu. So here the question is for asking, conducting meeting 15 days, lead bank for taking decision 15 plus 30, 45 days aa gaya. Member banks ko 45 plus 30, 75 days aa gaya. This is regarding NOC, right? Next, we will go to next one. Objection, I told you 15 days they have to reject. Next, syndication. This also question has appeared 2 years back. Syndication, what is the syndication? Suppose one borrower says, sir, I want to 500 crores loan. He will come to Canara Bank. 500 crores loan he is asking. Canara Bank says, no, I will give you only 200 loans since you are new party. I don't know. I will give only 200 crores. So what he says, anyway, you are ready to give 200 crores. Or if you are also not willing to give, you try to get loan from other banks. Whether you take share or you don't take share, doesn't matter, but arrange me finance from other bank. So what party will do? He will give his project report or financials to Canara Bank because he has approached. So he is giving mandate to Canara Bank stating that I want finance. Canara Bank will negotiate on my behalf with other banks. Canara Bank, what it will do? It will prepare information memorandum containing full details, terms, conditions, financials, everything, project, everything they will incorporate and give information memorandum. This will be circulated among other member banks. Whoever willing to give, they will participate. So this is arranging finance on behalf of the customer. This is called loan syndication. Here the question is, what is mandated bank here? Party is approaching bank, Canara Bank or whatever, approaching one bank. That bank is called mandated bank because party is giving mandate to that bank stating that you arrange finance from other banks on my behalf. I will not request, you request on my behalf. This is what mandates. So mandated bank concept is in which type of arrangement? That is the question asked. It is loan syndication, mandated bank. Information memorandum is nothing but containing full details, terms and conditions, etc. Next, Indian scheme for financing Indian companies for acquisition of equity in overseas companies. In overseas companies, if somebody want to invest in overseas companies, equity, in such case, that also we will give, but provided high net worth rated companies, AAA or LR1, LR2, good corporates only, whose tangible net worth shall be minimum 100 crores as per latest balance sheet. And what is the maximum quantum of loan? USD 1 million is minimum and maximum twice the tangible net worth of the company. Here, term loan in Indian rupees also we will give, or in foreign currency also we will give. Maximum repayment is 60 months, 72 months in exceptional cases. This is for acquiring equity in other countries. Next one, FCLR loans, foreign currency loans to residents. So instead of INR Indian rupees, we may finance foreign currency loans also, since they may need. So this is guideline is only 3 currencies, US dollars, GBP and Euro. 3 currencies will permit. And the minimum loan component is $150,000 in case of working capital loans or term loans, and $50,000 in case of short-term import financing. So this is the quantum of loan, FCLR, foreign currency loan to. Here, foreign currency loans for liquidation of existing rupee term loans. Party says, I am having term loan with so-and-so bank or your bank. No, you give me FCLR and liquidate this loan. That is also permissible, because when we will sanction such type of loans, suppose party is getting some export proceeds in a future date. That means forex exposure for him, hedging is not required. If hedging is there, that is also costly, so they may not come for that. Already somebody is having advantage of natural hedging. That means they are about to receive some funds from abroad, maybe some time it will take. So why I have to pay higher rate of interest here? You give me FCLR. So in such cases also we will finance, provided residual tenure of this term loan is minimum, not less than 5 years. This is FCLR for liquidation of rupee loans, right? Next, granting of FCLRs to non-banking NBFCs also we will grant, but it should be AAA rated company, NBFC, and maximum quantum US dollars 5 million only. Repayment working capital 1 year and term loans 3 years. And in this, I think last one in investment, different types of borrowing arrangements. Lending to infrastructure investment trust. This infrastructure investment trust, it is similar to mutual fund. Similar to mutual fund. What they will do, they collect money from public, those who want to invest. they collect money and invest this amount in infrastructure sector for acquiring promoter stake. Acquiring promoter stake means indirectly taking share in that investment, that infrastructure company. Right? So here bank finance should be restricted to 50% of the finance required for acquiring promoter stake. This is general guideline in any term loan. What we say is party's margin is this much. Say 25% margin you are prescribing for term loan. In case of big loans, it will come. Out of 25%, minimum half should bring from his own sources. Apna paisa chahiye, not borrowings from outside. Remaining half may be from outside borrowings subordinated. That is what quasi-equity we call. So that is outside borrowings towards equity. So here also same condition, only 50% is his funds and 50% this trust will provide maximum. That is why 50% is restricted to 50% of finance required. Next, holding of investment IT in the underlying asset should not be less than 1,000 crores. While financing to such infrastructure investment trust, its net worth should be 1,000 crores and assets also 1,000 crores. Second condition. Next, total exposure to this entire investment to this investment trust is maximum restricted to 1,000 crores. Bank as a whole, such finance is restricted to 1,000 crores, and to individual infrastructure trust, it is applicable for maximum limit of trusts. We have already seen, I think I will cover next. Trust ke liye maximum we will give 100 crores. That is under prudential exposure norms. Here also same norm will apply. For single trust, we will sanction only 100 crores maximum amount, and put together all loans to such type of investment trust is restricted to 1,000 crores from our bank as a whole. And margin here, 50% margin, already we have discussed this. Debt equity ratio 1:1. And DSCR 1.5, it is common. SA may accept 1.25, repayment 7 years. Well, lending to such trusts. This is about investment trust. Next one, interbank participation certificates, IBPCs. What is this again, IBPC? We have seen priority lending certificates. Suppose if somebody is having priority sector loans, more loans, they may bundle those loans and sell to some other banks in the form of these certificates. That is priority sector lending certificates. Similar to that certificates, this may be priority or may not be priority. Some loans they will bundle and sell in open market because they are already giving more loans and they want funds. So such banks, they may lend in market, banks or NBFCs in the interbank. This is among banks only, interbank participation certificates. So here two conditions here, period 91 to 180 days with risk sharing and 90 days without risk sharing. Without risk sharing means simply handing over that whatever this bond is there, simply handing over, and whatever risk is passed to other bank, then it is risk sharing. If risk is not passed, simply bond we will give. After 90 days again we will take back, and for this 90 days only we will pay some amount. That is without risk sharing. Next, banks with minimum CRAR of 10% are eligible to subscribe. Not all banks. Next, co-lending by banks and NBFCs, including HFCs. This is also last year recalled question. Sometimes NBFCs will go on the market and they finance one party. They will have tie-up with our bank. With our tie-up, they go and finance one party and pass on some loan to us by keeping some loan. Last year question was, through tie-up with NBFC financing, what is the maximum share NBFC has to keep and what is the maximum share they can pass on to banks? So a maximum 20%, sorry. Yes, they have to retain minimum 20%, they have to retain NBFC. Remaining 80% they can pass on to bank. So 80% of the share they will pass on to bank and keeping minimum 20% share with the NBFC. This is co-lending by NBFCs, including housing finance sectors. Next, digital lending framework. This is only end-to-end, just like our PSB 59 gaya. Iske saath again we have come out with one more up to 10 lakhs. This is just Mudra loans, etc. Direct lending, it is started. end to end through digital network. From identification onwards up to repayment, everything identification plus KYC and documentation and follow-up, recovery, everything digitally they will do. For that, what they say is name of digital lending platforms engaged by agents, it shall be disclosed on the website of the bank. Next, operational processes and systems. We are going for next chapter, operational process and systems. So in respect of all credit proposals, 1 crore and above, what bank says is relationship should be done by separately and appraisal will be done by separate. Suppose a branch level, what they will do, relationship person will be separate and appraisal person will be separate in a larger. Small branches, branches will do relationship and next higher authority at circle office, they will do appraisal functions. Both should be separate. That is simple guideline. Bus. Next, submission of credit proposals. Briefly, I will tell because it is common. Earlier guideline was that higher authority, suppose branch want to submit proposal to circle office. They says you send it to RO, RO will send it to CO. So it was taking time. That is why now bank has come out with a modification. Wherever direct proposals are there, you send directly. I will tell you. Here CGM, CO, CAC powers, LCBs are there. CGM, COC powers directly they will submit to CO. And beyond CO power side, directly they will submit to HO. Suppose HO power accounts, directly LCB is sending. So what is the circle's role? One copy will be given to circle. Circle within 2 days, they will submit one front sheet that containing brief details. Front sheet with their recommending or whatever it is, they will forward it to head office. So to reduce the time, turnover on time, this is. HO proposals, directly send it to HO, copy to CO. Similarly, branches or whatever it is, ROs, etc. Next higher authority proposal, send directly to next, direct to sanctioning authority, duly endorsing a copy to immediate next higher authority, so that they will review and they will prepare a front sheet and forward to sanctioning authorities. That is what here all conditions. We need not to waste much time on this. Simply that one only. Propose, directly submit, copy to next controlling authority, they will send front sheet. Next, submission of credit proposals of MSME branches. Here MSME branches proposals ka recently it has come out on a cutoff limits 25 lakhs. For this MSME Sulabs, this is 25 lakhs and above loans. We have to give it to SME Sulabs. Here the condition is branch power. Suppose scale 1, 2, 3, 4 are there. If the proposal falls within branch powers, if it is a below 25 lakhs, branch has to do. But if it is above 25 lakhs, in such case, you send it to SME, MSME Sulab. This is the guideline, right? Next, participation in bids or quoting of rates. Here it will, in head office, this will be done. What this quoting of rates is, suppose some good government account. Say here so many projects we have seen like our Kaleshwaram project or Mission Bhagiratha or some other project which is floated by government or government undertakings, public sector undertakings, they are approaching for loan. So what we will do, or what they will do, which bank is giving for lesser rate of interest, they will see pricing, rate of interest and commissions. Which bank is offering at reasonable rate, to that bank only they will go. So for that we have to give quotation. Quotation dene ke liye party will submit request, that company will submit request to us. So this note we will put up to ED or MD and they will take decision. Yes, our offer is this much rate of interest we will accept and this is our charges. That quotation we will send it to the borrower. If they are acceptable, they will submit proposal. Otherwise, they will go to some other bank. This is what quotation, quoting of bids. Here, ED up to 300 crores loan requirement, ED will give quotation rates and beyond 300 crores, MD will give. And subsequently, after coming application, again, it will be thoroughly studied and then finally sanction is there. It is only just preliminary sanction with it. Preliminary sanction consent. Right. Now, general guidelines. General guidelines. Just I will go through first wherever it is not that much important for exam or easy one only. So here for general guidelines for availing credit facilities, generally audited balance sheet we should take at least for 2 years. Here, that is what T+2, T2 and T1, at least for 2 years. Suppose if audited balance sheet is more than 6 months old, then from the date of balance sheet till date, we call for provisional financial statement. What is the development? That means after balance sheet, there may be some deterioration. To decide that provisional financial statements, we call from the date of balance sheet to till date. If it is more than 6 months old, not all cases, right? Next, financial statements like audited balance sheet, P&L submitted by companies to be verified with the financial statement of the company filed with MCA, the Ministry of Corporate Affairs, because sometimes it may vary whatever they have filed with Ministry of Corporate Affairs and whatever they are submitting to us. That is why now bank has come out with guidelines. Whenever such next point is that only whenever somebody is submitting financial statements signed by chartered accountants, you verify in UDIN portal. First, we will verify balance sheet in Ministry of Corporate Affairs there. And again, regarding chartered accountant also, they will upload this in UDIN portal, chartered accountant ka ICI, Institute of Chartered Accountants of India. So there also you verify both. This is good CDD, due diligence. Next one, in case of proposals wherein the limits are above 5 crore, a copy of the passport of the promoter, directors and guarantors are to be mandatorily obtained. 5 crores, above 5 crores, passports we have to obtain. Suppose passport is not there, party says today I don't have any passport. You take an undertaking letter, whenever passport I receive, I will submit a copy to you. This is what, right? Now, LEI, legal entity identifier, this is also frequently asked question because it has come about 4-5 years back, started, but still the process is going on. Yeah, still the process is going on. That is why legal entity identifier, general guideline is that exposure of 5 crores and above, they should obtain, that is non-individuals. Non-individual borrowers, 5 crores and above, if they are enjoying credit limits, they have to submit legal entity identifier. This is guideline. But immediately all people, they cannot obtain. So government has given some time up to 30/4/2025. So now in exam, they are asking cutoff dates. Cutoff dates. Suppose 5 crores and above, wala accept, they have to submit legal LEI means up to 30th April 2025 date is there. 10 crores to 25 crores wala submit karne ke liye up to 30th April 2024. Current year up to 2023, April 30th April 2023, 25 crores to less than 50 crores people, they have to submit. That means by this April end, all exposures with 25 crores and above, they should have submitted LEI to bank. Apart from this, recently it has come 50 crores and above. Yeah. Apart from this, 50 crores and above, remittances also now they want LEI recently. That also we will cover next. Anyway, next one, report from Central Economic Intelligence Bureau to be sought for exposures above 50 crores. This is another guideline for above 50 crores. In case of prospect, that's somebody is coming for loan, new borrowers. For them, 50 crores and above, if they are asking, then report from Central Intelligence Bureau you have to call for. Similarly, existing loan, any 50 crores and above, if it slips to NPA, and there also you should obtain report from Central Economic Intelligence Bureau. Right? Next one. Assessment of group risk. What is this group risk here? Group risk. Suppose if some in entire group, this group may be having 6-7 accounts of that group company. 1 or 2 companies may not be doing good. In such case, what happens if one company is not doing good means this fellow may divert funds from good company to bad company also. Like that, some risk is there. To avoid such type of risk, group risk avoid karne ke liye, what this is, key financials. What are the key financials? Turnover, net profit, leverage, T&W, liquidity ratios, etc. of major group concerns. Major group concerns, again, what this is, wherever above 30% of paid up capital is common. That means the holding company, wherever it has invested above 35% of paid up capital, then it called as a group company for this purpose. And all such companies of financials, You have to analyze and incorporate in the office note. So this is to avoid group risk, assessment of group risk, right? So holding above 30% of paid up capital in group companies. Now we are coming for assessment of working capital. Working capital assessment. 3 methods are there. Anyway, I will cover before tea time these 3 methods. First one is turnover method. Turnover method. This is otherwise called as PR Nayak Committee recommendations. PR Nayak Committee. So what is this turnover method? Party will give you balance sheet and P&L account. He will give what are all my sales for next year, this year sales and next year sales. That is called turnover. So we will compare this year sales, how much he has given, next year sales also how much he has given. If the sales are reasonable, yes, we will accept. So you are accepting projected sales of the party. When you have accepted projected sales, on projected sales, 25% of projected sales is working capital requirement, not loan, I am telling. Because in 1 to 2, they are asking this question confusingly. Sometimes they are asking working capital requirement and sometimes they are asking working capital finance, loan. So 25% of the projected sales turnover is working capital requirement. So out of requirement, out of working capital requirement, party has to bring, he has to bring 5% of the turnover. So 25% may 5% is margin and 20% of turnover is your limit, permissible limit. But here one more condition. If party is having net working capital in the system more than 5%, that means he is having more NWC. In such case, we prescribe that NWC as margin, not exactly 5%. Either 5% of the turnover or available NWC, whichever is higher, we accept it as a margin. Simple for understanding this, whichever is higher, I will tell you. A borrower will come for a car loan. He says, sir, my car value is 20 lakhs total on road price. And our scheme permits 90% on road price. Borrower says, we are telling, I will give you 18 lakhs, your contribution only 2 lakhs margin. Party says, no, sir, I am having 5 lakhs. Why I have to pay interest on this 5 lakhs? You for you 18 lakhs लेके 3 लाख को additional क्यों interest pay करना? मुझे कम करो, मुझे sufficient 15 lakhs. So what we do? Available. So your margin prescribed is 2 lakhs only, but party is having 5 lakhs. So accept 5 lakhs as margin and give 15 lakhs only. Similar condition here also. 5% of the margin are available net working capital, whichever is higher is margin. So applicability here. Sometimes they may ask questions also stating that turnover of a party, projected turnover is 5 crore rupees, projected turnover. And what is the maximum working capital requirement under turnover method? So 5 crores may you have to say 25% is 1.25 crores. It is working capital requirement. If they ask what is the finance permissible, then 20% of the turnover. So 5 crores may 20%, 1 crore. 1 crore is the permissible finance. Like that we have to say. Right. Next, turnover method. My second point is applicability. Turnover method applicable for MSME up to 5 crores and other than MSME up to 2 crores. And traders, merchants, etc. up to 2 crores. This is applicability. Next. However, borrowers can opt for MPBF or cash budget system and bank can employ if it is the same more suitable. Here, one thing we have to remember blindly, whenever party is asking for MPBF particularly, MPBF is more powerful in out of these 3 systems. And if party is opting for MPBF, we should go under MPBF system only. We say you are eligible for turnover method. Party says, sir, I am having current assets. You go under MPBF. Yes, you go under MPBF. You can't say, no, you are eligible for only turnover, I will go. So this is simply for understanding purpose. Right? Next, current ratio is 1.25 for this. So 3 points here in turnover method. One is accept turnover में 25% is working capital requirement, 20% is our finance, 5% are available NWC is the margin, and applicability is up to 5 crore for SME, up to 2 crores for non-SME, and the current ratio is 1.25. Bus 3 points. Next, MPBF system, right? MPBF system. This is applicable beyond cutoff limits of turnover method. This is applicable beyond cutoff of turnover method. That means what is turnover method? Up to 5 crores, it is for SME, up to 2 crores for non-SME. So beyond that cutoff, up to 25 crores, this MPBF system applies. And limits beyond 25 crores, it will go to either MPBF or cash budget at the option of the borrower. So here MPBF may applicable here applicable to beyond cutoff limits, current ratio applicability is 1.33. So simply here also how we will assess, I will tell you. Total current assets we will see first. How to assess this? Total current assets, otherwise called as gross working capital. Total current assets, otherwise called as gross working capital. So उसमें कम करना, क्या कम करना? Current liabilities excluding bank borrowings कम करना उसमें. Current liabilities excluding bank borrowings. Then comes your net working capital gap, WCG, working capital gap. Suppose I will tell you through this also example. One person says, sir, my current assets are 50 crores. Current assets are 50 crores. Current liabilities other than bank borrowings are 10 crores. So 50 minus 10, 40 crores आ गया. 40 crores is working capital gap. So working capital gap क्या है? This much I require. 40 crores is required because already my current assets I am having 50 crore. 10 crores somebody has financed other than bank finance. That is current liabilities other than bank finance. So 10 crores somebody financed. Remaining 40 crores is yet to finance. That is what working capital gap. 40 crores में आप थोड़ा दे दीजिए. I will bring something. You give some amount, I will bring remaining. That means margin. So what is the margin here? 25% of current assets is the margin. Current assets कितना? 50 crore बोला. 50 crores is current assets. 50 crores में 25% is 12.5 crores. 50 में 12.5. So 12.5 crores is the margin. 40 is working capital gap. 40 में 12.5 निकाल दिया तो 27.5. It is the maximum permissible bank finance. Like that we will arrive here. Maximum permissible. So total gross current assets are working capital. Total gross working capital minus current liabilities excluding bank borrowings. That is already somebody has financed other than bank. To that extent we will reduce. Then comes working capital gap. Working capital gap में bank will give some portion. Party will bring some portion. What is party's contribution? 25% of current assets are available net working capital in the system. Here also same guideline. Are available net working capital in the system. Whichever is higher, party's margin, and remaining is our permissible bank finance. This is regarding MPBF. And third one, cash budget system. Cash budget system. Cash budget system में it is projected cash flows what we will take. Projected cash flows. How we will take? Say this is January. February में ये कितना पैसा आना है? What are cash inflows? What are cash outflows? What is the gap here? We will see. Next March में what is the inflows of cash? What is the outflows of cash? We will calculate gap. So that gap we will cumulatively for 1 year we will calculate. We fix that limit. That is why it is called as gap financing or gap funding. That means in cash inflows minus cash outflows. What is the gap? That gap only we will finance. It is called as cash budget system. Basing on estimates of cash inflows and cash outflows and cash deficits. And now isme mostly they are asking question is applicability. Applicability is number one above 25 crores. Second one, seasonal industries. It is applicable like tea, sugar, etc. And software development, construction activities, and NBFCs. These are all applicable for this. So again, I told you whenever party says, "Sir, मुझे MPBF system चाहिए," go under MPBF. Right? In cash budget में another one added about 3 years back, we may finance term loan also under cash budget. Where we will finance good rated company, somebody says, sir, I have to receive something from government, or our bank has installed a POS machine, there they are expecting some receivables. So such receivables, against such receivables, that is cash flows, expected cash flows. I expected cash flows में कुछ portion we will give, that is called discounted net cash flow. Not exceeding 3 years term loan we will give. This is addition regarding cash flow financing, right? Next, construction companies, they says it is 9 times of net owned funds. 9 times of net, again it is the next higher authority may give leverage, and assessment of NBFCs I told you under cash budget system only, right? Next, last one I will start with before tea time I will finish up this gold card scheme for exporters, standby credit limit. What the standby credit limit says, while assessing working capital requirement for this borrowers, wherever these exporters, while assessing working capital requirement of exporters, 20% over and above assessed limits you assess, because they may need for urgent necessities. This is called standby credit. And you keep it side, if 40 separately requires the 20%, he will avail maximum 2 times only in a period of 1 year, whatever the period it is given. But at a time when you are allowing maximum 60 to 90 days only you allow. That means at the time of renewal, you are giving some standby credit. The standby credit party may avail if required 2 times in a total period he will avail, but each time it should not exceed availment 60 to 90 days only. If you are allowing today, he has to regularize this within 60 or 90 days at a time, right? Next, of course, borrowers crop loan. Crop loans up to 100 lakhs, it is not applicable. Above 100 lakhs, RO head authorities and above can waive. But this is regarding this. Next one, we will go through after tea time, because we break for 15 minutes tea time. Exactly 11:45, we will assemble here and continue with the remaining. Okay, thank you. Access, yeah. Close the window, okay. New Word document. Yes, sir. Yeah. Now I will come for tea, sir. Yeah, it is coming here. Yeah. Is it? Huh? 10 minutes is there. So, okay, sir. Yeah. इसको आना इसको बंद करके ये ऑन किया तो अगेन आवाज आता है वो नहीं दिस इज क्लोज है आवाज ज्यादा है ना इसलिए कैसे है Start. Yes.
Sir, I have started recording.
Now, yes, sir. Yes, sir. Now, next one is lending on the guarantees issued by other banks or financial institutions. Here, question comes: why other bank has to give guarantee? Instead, they can give. Guarantee. So that problem is sometimes particular bank's exposure to a particular sector may exceed some ceiling fixed by concerned bank. In such cases, what they do, since there is ceiling for fund-based exposure under particular sector, they give guarantee and they says, Baba, we don't want to leave you. I will give you guarantee. You go and take from some other bank like that. So this arises. In such cases, lending on the guarantee issued by other banks. Suppose somebody brings other bank's guarantee, then we will finance. But here condition is he should have satisfactory dealings with the bank for at least 3 years. Hamara pass. Second one, the guaranteeing bank should have a fund-based exposure to the party to the extent of at least 10%. Suppose other bank is giving guarantee of 100 crores. Simply वो उसके पास 1 crore firm based रही बाकी 100 crores हमें दिया तो नहीं चलेगा. 100 crores में 10% means at least 10 crores they should enjoy limits with that bank. Then only we consider here. That means total fund based risk they should not switch to other bank. Next, liquidity and current ratio norms. Already regarding current ratio norms, I have discussed turnover method 1.25, MPBF and cash budget 1.33 is our cash current ratio norms. These are, suppose current ratio is less than prescribed, that means less than our 1.33 or 1.25. What we have to do here? Here we call for quarterly cash flow statements for borrowers enjoying 50 crores and above from the bank. So wherever current ratio is less than prescribed norms and party fee is enjoying 50 crores and above, quarterly cash flows statements we will call for and analyze whether the unit is going normally or not. That is for monitoring purpose. That is one guideline. Second one, about 2-3 years back, again we have come out with another new monitoring one. This is in case of projects with over 250 crores and above from banking system, entire banking system. If some borrower is enjoying 250 crores and above, or that party is enjoying 100 crores limits, either term loan or working capital with us. For such parties, what we do, we appoint ASM, agencies for specialized monitoring. We call ASM, agencies for specialized monitoring. That is what approved or empaneled firm they says. This ASM, what they will do, quarterly, they check cash flows of this unit quarterly. So this is another tool for quarterly. Of course, in monitoring tools also will come agencies for specialized monitoring, wherever 250 crores and above, if they are enjoying from banking system, 100 crores and above, if they are enjoying from our bank. In such cases, we appoint, or lead bank will appoint ASM, agencies for specialized monitoring, who will monitor quarterly financial statements or financial all cash flows of that company. And for them, charges also payable. Borrowers with limits up to 500 crores, 5 lakh rupees per annum, not each occasion, 5 lakh rupees per annum plus taxes, whatever GST we will pay. If borrower is enjoying more than 500 crores, then 8 lakhs per annum we will pay to the ASM, specialized monitoring chartered accountant, whoever is. So this is about less than CR, what is the guideline. Next, quick ratio. Quick ratio. What is this quick ratio? current assets minus stocks, whatever assets quickly convertible into cash, they are all we call as quick assets. Simply telling current assets minus inventory, stocks, quick ratio divided by current liabilities. So this ratio also, earlier we are telling only current ratio this much 1.33 or 1.25, it should be there. And quick ratio also now bank has prescribed for whom MSME borrowers with total above 10 crores exposure and other than MSME above 50 crores. Now quick ratio also introduced. We have to see this also. What is the desirable level? For two tables, bank has given very lengthy one. So simply for remembering 0.61 to 0.93, basing on type of industry. For each industry they have given. Basing on that, quick ratio 0.61 to 0.93, it is varying. That is acceptable levels. Right? Only thing is for applicability, you may remember quick ratio is applicable for desirable quick ratio is applicable for MSME borrowers above 10 crores and none other than MSE 50 crores, above 50 crores. Compliance of sanction terms and conditions NF 482. Normally we take this. What are all mentioned, that also we will come in monitoring tools because it is also one of the monitoring tool. Next, fixation of time schedule for working capital limits. Earlier it was basing on risk rating, different was there. Now it is fixed at 12 months for all. Only exclusion staff OD, GLOD and crop loan KCCS. This is exempted. On all cases, 12 months is your working capital limit we will fix, irrespective of risk. That is another one. Next, putting through mortgage or EMT or mortgage transactions. Normally, at the time of sanction, what we do, the security creation for mortgage, etc., certain time it will be permitted. Party says we could not do perfection because some problem is there regarding registration. Ye wo bolega, first extension will be done by sanctioning authority. And still, some problem is there. Up to second extension also, sanctioning authority will, that is maximum 6 months. And subsequent to that, next higher authority. Of course, for housing loans again it is given, maximum period also given, basing on that they should do. Otherwise, penal charges will apply, right? Next, this is regarding loan system for delivery of bank credit, LSDBC. It is very old concept. What is this LSDBC? I will tell you. You are sanctioning 500 crores OCC limit to a party. That party, what he will do, he is having funds already with him, sufficient funds. He will avail only 10 crore rupees. So you have given 500 crores OCC limit, party has availed only 10 crores. Remaining 490 crores, you are earmarking, you are unable to give loan to other people because this fellow, anytime he may use OCC means anytime he may draw. So otherwise our ALM mismatch will be there. So what Reserve Bank says, big parties, they should not misuse facilities like this. So Reserve Bank has prescribed, while fixing working capital limits 150 crores and above from entire banking system to any borrower, if you are fixing working capital limits 150 crores and above, don't give total OCC, you fix minimum 60% of that sanction working capital limit should be working capital demand loan. What is this working capital demand loan? Single transaction. Today we will disburse, we will give time, party will repay after some time, whatever permitted time. The time also minimum tenor is 7 days, it is permitted minimum, maximum up to validity. That means in the form of loan, party has to avail minimum 60%, remaining 40% only we will give cash credit. Here advantage is up to 60%, there is no other go, party has to avail. If he is not availing, we know that 60% he may approach later, but their tenure is there. How much period is asking, everything it is available, so that we will plan our asset liability mismatch. Without mismatch, we will plan asset liability wala. That is the advantage for banks. So loan system for delivery of bank credit applicable for 150 crore and above, working capital limits from banking system, number one. Number two, minimum level of loan component, that is working capital demand loan should be 60% minimum. Remaining 40% will be cash credit. Maximum 40% it will come, not more than 40, because it is mentioned as minimum. WCDL may exceed 60 to 70 also it may go, but RBI prescribed minimum 60 should be there. And minimum tenure of loan component is 7 days. Another condition here, credit conversion factor for undrawn portion of cash credit limits. Here again, in last example, 500 crores loan diya, working capital, 500 may 60% already, 300 crores we fixed as working capital demand loan. Remaining 200 crores party has to avail as per our example. But instead of 200 crores, party has availed 100 crores only as on balance sheet date. So remaining 100 crores is undrawn portion. Therefore, calculation of our capital, you convert into 20% and maintain capital on that. So undrawn portion, 200, 300 is WCDL and 100 party has availed, 100 is undrawn portion, 100 ko 20% means 20%, 20 crores. On 20 crores, you maintain capital. This is what Reserve Bank says. That is conversion, credit conversion factor for undrawn portion of cash. Earlier, one condition was there. Unconditionally cancelable limit hai to, you need not maintain capital on that portion. Only if it is cancelable conditionally, then only you apply capital on that. Like that, Reserve Bank earlier has given some leverage. But for this, there is no such leverage. Whether it is unconditionally cancelable or not. Unconditional cancelable का मतलब क्या है? I am telling you ना 300 crores already WCDL हो गया, 100 crores as it is CC avail किया. Remaining CC, if you have got agreement with the party that any time it is cancelable unilaterally by bank, even without consent of customer, then it is called as unconditionally cancelable. In such cases, earlier Reserve Bank told, to that extent, don't maintain capital. If it is cancelable, don't maintain capital on that unavailed portion. But for this, whether it is unconditionally cancelable or not, you have to maintain capital. 20% conversion, right? Next, computation of drawing power. This may be one question they are asking that we will discuss. What is this drawing power computation? How to arrive drawing power? First, we will see total stocks less unpaid stocks, if any. Then we will arrive paid stocks minus margin 25% or 20 or 30%. Then arrive DP, drawing power on stocks. Next, book debts, total book debts. Out of that, any discounts made, book debts or any factoring already diya, wo kam karna. Then outstanding book debts for DP. उसमें से 30% or 40% margin कम करना. Then DP for book debts will come. DP for stocks and DP for book debts. Total we will give. This is your drawing power. This is what we calculate normally. But for stocks, drawing power against stocks, normally we are deducting that creditors for goods. That is unpaid stocks. I told you, no, stocks minus unpaid stocks. That is creditor for goods. So we have to deduct normally, but with GMHO, CAC and above authorities permission, we need not deduct sundry creditors, that is stocks, unpaid stocks. To what extent? To the extent we have permitted at the time of sanction. While doing processing, appraisal mein, what are all the sundry creditors we have accepted? To that level, you need not deduct. For example, I will tell you, 100 crores is stock, 100 crores, and 10 crores is sundry creditors. In balance sheet, party has already mentioned 15 crores as sundry creditors for goods. That means it is below accepted level. So you need not deduct this, whether he is unpaid stocks 10 crores or 15 crores, because 15 crores we accepted at the time of sanction. To that extent, don't deduct stocks, unpaid stocks. You permit on full amount, whatever full stocks are there on that without deducting sundry creditors, but GMHO, CAC and above authorities. So this question is appearing 2 to 3. It has seen, I think 2-3 years back it has come. Right. Next. Now we are going for term loans and DPG, deferred payment guarantees. Deferred payment guarantees also, we have to do appraisal similar to term loans, because the deferred payment guarantees means somebody is purchasing machinery from supplier. Supplier will give him credit. Borrower, our customer ko credit dega, immediately you need not pay. You take machinery now and pay every year 1 crore rupees. 10 साल के लिए payment करो 10 crore. So he has given time. That is, so what he will do, whether the 10 crore tak ka payment karega ya na, mujhe nahi malum. What you have to do is, you bring me bank guarantee from your bank. I'm guaranteeing my full amount. 1 crore ab diya, baki 9 crores ko guarantee de do. So he will submit bank guarantee for 9 crores over a period of 9 years. That is what deferred payment guarantee. Next installment party jama pay not paid, then bank will pay because already guarantee is issued. This is called DPG. So DPG also, it is longer period for purchase of machinery. That is why it is also processed as per term loans. Bills co-acceptance for similarly, bills co-accept is nothing but just like your guarantee only. Apart from, we are also accepting bills. Party has accepted, yes, I will pay every year. We are also telling, yes, we are accepting co-acceptance. Machinery supply karo, just like DPG. Machinery supply karo, open payment nahi kiya to we will pay. You send us bills. This is what. So all these term loans, how we will analyze, we will come to one to. First one is definition of term loans. Any loan repayable in more than 1 year is called as term loan. Again, usme two types are there. One is medium term loan, above 1 year up to 3 years. And second one, above 3 years repayment aito long term loan, medium term loan and long term loan. Mostly definitions 1 to 2 they are touching us. Next, while considering infrastructure proposals, mechanisms like escrow, creation of debt service account. What is this escrow? Escrow means separate account we will create, separate account. So somebody is going for road project. We will open separate for this road project. So from Hyderabad to Karimnagar, separate road is there. For this road project, we will create separate account that is called escrow account. For this purpose only we are opening. Party has to route all his amount related to this project through this account. Other cash, he may have some other projects also. So related to other projects, he will route through other accounts. So this is called escrow mechanism, particularly for this project only. Creation of debt service reserve account. This normally while sanctioning loans in banks, we prescribe debt service reserve account. That means debt service reserve account means equal to 3 months payment installments or 6 months installments. What we do, sometimes party may not pay in time. Then account may become SMA or NPA. So problem will come. To avoid that problem, as a precautionary measure, what we say, you create one debt service reserve account. Wherever you have got some surplus funds or you are getting some funds, you keep in this account in the form of term deposit or whatever it is, equal to 3 months or 6 months installments. If you are not in a position to pay our any installment in time, then we will debit this KDR and adjust for this. This is what debt service reserve account. Debt servicing karne ke liye one account is reserved separately, this DSCR. This is applicable in case of term loans only. Next, monitoring of cash flows through trust and retention account. Trust and retention account. This is similar to escrow, but here what happens is trust and somebody is collecting toll. Road project, already the person has already completed road and started toll collections. Toll collections, if you just like that, if you allow the party, he may divert to some other account. So what we do, we create separate trust and retention account. All toll collections should be created to that account only. From that account, party, it will be not, debits will be allowed towards this project only. There will be a mechanism which is called as waterfall mechanism. In waterfall mechanism, what they say is, first debits will be allowed to maintenance of this toll collection wala wo sabko liye maintenance of roads etc. Road may. And next amount will be towards interest of bank. And third, next amount will be towards principal. Like that mechanism is there. Then workers dues, then government dues, like that. Serially, it will be written in this escrow agreement, this agreement, TRA agreement. It is called waterfall mechanism. There is no checkbook here. We will allow only through debit slips as per waterfall mechanism. That means these cash flows are in banker's hand. Party he cannot utilize for other than project purposes. Yes. So this is trust and retention account. So these are all mechanisms applicable in case of term loans. And another one, appointment of lenders independent engineers, LIE we call. Lenders independent engineers means for particular project, we appoint one engineer, one engineering company on our behalf, on lender's behalf. He will go and talk on behalf of us, and whatever progress is going on, he will report to us only. This is what lenders independent engineer. He work on our behalf and take amount from party. Party amount we will pay from and collect from party. But he will take care of interest of bankers because he is appointed by bankers. That is called lenders independent engineer. So these are all mechanisms in term loans to safeguard our loan, to induce ensure करने के लिए these mechanisms we will follow, right? Next, hybrid annuity model is one of the latest mechanism under PPP to implement road projects at an increased pace of awarding and construction by National Highways Authority of India. What is this hybrid annuity model? I will tell you this hybrid annuity क्या है. Normally, road project में PPP में what they will do? Simply government will give only initial some amount they will give or they may not give. They say, sir, 30 years you develop road and 30 years you collect toll, and after 30 years you hand over road to us. You maintain for this entire 30 years and collect toll charges for 30 years or 20 years, that concession agreement, whatever it is there. This is what normally in PPP happening. But in some cases what happens is, any road which is not having that much traffic, toll collections are not as expected. Suppose they may not come because it is in advance only, expectations that toll collections may not be sufficient. So nobody will come forward, contractors who road project ke liye. No, it is not economical. Why I have to go for road project? So no borrower will come. Then what government will do? Arey Baba, you go with road project. I will give you some amount every year. Say your expected toll collection is 100 crores per month. Expected toll collection. Suppose if 100 crores are not reaching, what I will do? Every month I will give you, as per estimations, maybe 25 crores or 30 crores. Every month I will give you. Baki you collect toll collection and pay. So my assurance is every month 25 crores or 30 crores till closing of this project. Maybe 20 years or 15 years, 30 years, whatever it is. Till the time I will go on paying you monthly some amount. It is called annuity. Annuity means yearly. Yearly some amount I will pay. This government will give assurance, and here partly government is giving and partly toll collections are there. That is, it is called as hybrid annuity model. So now it is becoming famous, and for this also we will finance, right? Next one, tail risk. This is another problem in our term loans. Mein tail risk kya hai? Tail risk means this again in our projects. Mein suppose road project is there. Road project, we are giving repayment for 20 years because party has got agreement with the government for 22 years or 25 years. So before that time repayment is to be completed. That is why we have given repayment of 20 years. Sometimes what happens is party says, sir, first 5 years I am not getting that much income. So first 5 years thoda repayment kam karo. This repayment, whatever is left over, last 5 years may this repayment you add. That means installment first 5 years come karo. Instead of 10 crores per month, first 5 years you put 5 crores per month. And last 5 years may, instead of 10 crores per month, ye 5 crores add karke 15 crores per month, like that you enhance. Like that proposal may come. In such case, what happens is, if you accept such, it is acceptable. But if you accept like that, what happens? Last installments में ज़्यादा amount आना 15 crores repayment करने के लिए. Suppose if expected income is not coming, then default may occur. He cannot pay 15 crores because expected income is not coming. That is called as tail risk. If you keep more amount towards payment in the last installments में, the tail risk is there. उसीलिए for avoiding tail risk, what you do is 75% of the loan should be cleared within first 75% of the period. That is cash flows, whatever it is coming for total repayment. First 75% cash flows hai na, that first 75% period mein clear karna. So 20 years repayment mein, suppose 400 crores is loan total. 20 years repayment you have given. First 15 years mein, usme 400 mein 75% means 300 crores clear hona, and last period aina jo 5 years mein 100 crores will be cleared. So first 75% should be cleared within 75% of initial period. This is what tail risk avoid karne ke liye this is. Tail risk should not be there, right? Okay, for the other, normally tail risk period is 25% for non-infra and 20% in case of infra. If restructured means 20% and 50% tail risk. Bus. This is not applicable for hybrid annuity because government guaranteeing is there. They are telling to up to 20 years, every year we will pay some amount. So assurance is there from government. So this tail risk is not applicable for hybrid annuity model, right? Next, reimbursement of term loans. This is our earlier general guideline only. A little fast we will go for this, where we will permit reimbursement and when reimbursement in case of term loans is permissible up to 25% of the term loan only. That too, they should have incurred for plant and machinery only, not for bad land and building. So expenditure incurred for plant and machinery up to 25% of our loan amount only reimbursable. Number one. And next, general guidelines, all party, no low risk, normal risk, and it has to be claimed within 6 months from the date of purchase. That is another condition. And the remaining thing, inspection, insurance, chartered accountant certificate, these are all common issues. So 2 points here, 25% of term loan is reimbursable and within 6 months party has to claim. Only for plant and machinery purchases only we will reimburse, not for land and building. Right. Next, annual review of term loans. In monitoring tools also this might have come. Anyway, just fastly I will cover. Term loans are sanctioned by circle head CAC and above authorities. Annual review. Suppose exclusive term loans they are, no other loans party is not having OCC. In such case, annually you review every year. From today's review onwards, another next year review will be there. This is one. For loans, circle head CAC and above authorities. And retail loans, if any sanctioned by circle head CAC and above, up to 5 crores, they are exempted from this second one. Standard restructured NPA not marked out for recovery, they are all eligible accounts for annual review. When you will do? From now and every year. Suppose ODOCC is also there at the time of renewal or review of ODOCC account, this annual review of term loans also you complete. This is the guideline. So here 2 things, applicability, CA head CAC and above, exempted, retail loans up to 5 crores. Bus. Next, conduct of project appraisal. This is also frequently asked question. In respect of new borrower, project appraisal shall be applicable to proposed projects. New borrower means proposed projects, including infra, with project cost up to 5 crores and above. New borrower aito 500 lakhs or 5 crores and above, project appraisal is to be conducted. Who will conduct that? We will see. Next one. For existing borrowers aito, basing on risk, low risk, normal risk, and moderate risk. That is what BBB. And better aito, project cost up to 1000 lakhs or 10 crores, up to 10 crores. For existing parties, good rating up to 10 crores. For existing parties, not good rating, below BBB, it is 500 lakhs and above, 5 crores and above. This is cutoff limit for conducting project appraisal. And next, regarding term loans, the agricultural term loans, for new customers, project cost above 200 lakhs here. Earlier 500 lakhs and here and above, here above 200 lakhs. For existing customers, above 500 lakhs. So this point you have to keep in mind. Anyway, again, agricultural policy, it is 150 lakh and 300 lakh is there in policy. But in our CRM policy, it is 200 lakh and 500 lakhs. Since the CRM policy is latest one, 666, 664 and 660. So we take this only, latest one, right? Next one. Approval of project appraisal, generally DGM at circle in case of PAC, project appraisal cell or project finance department, DGM will approve. And in HO level, HO, PAG, they will approve. Next, irrespective of sanctioning authority, project appraisal cell at circles, they should conduct, if DGM headed circles, if DGM headed circles, up to 50 crores, they have to do this project appraisal. If it is headed by CGM or GM, up to 100 crore, they have to do project appraisal cell. Beyond this cutoff point, it will go to project appraisal group at head office. Okay. Right. Next. Bank may utilize service of external TEV consultants are there. So we can use for this project appraisal, we may utilize external sources also up to 250 crores only. Beyond 250 crores, our PAG, our internal appraisal only, we have to do project appraisal group only, we have to do. Up to 250 crores optional, either outside wala or inside wala they can do. This is regarding project appraisal, right? Yeah, this is what I told you, financial parameters. One question they are asking, but simply for remembering, I have put in one small table form. Parameters, important parameters, whatever it is there. For transport operators, debt equity ratio, general 3:1, and it can be reduced to 4:1 also. One thing you have to remember, debt equity ratio, olden days we used to call 2:1 is common, but now 3:1 in general. Anyway, you see, transport operators 3:1, and up to 100 lakhs, it is 4:1, of course, and above 100 lakhs, 3:1. Agriculture also 3:1. 3:1, it can be reduced to 4:1. This is debt equity ratio. Debt equity ratio means total term loans divided by equity. Equity का means net, इसका total net worth में tangible net worth we have to see. So total outside debt divided by tangible net worth. This is what debt equity ratio. Outside debt means only term loans, not again your working capital finance. So total term liabilities divided by tangible net worth, debt equity ratio. This, what is this debt equity ratio? Generally, while financing term loans, we will see whether this fellow is purely depending on our loan or whether his contribution is also there. Here, what it indicates, 3:1. 3:1 means, suppose transport operator, a bus costing 2 crores. 2 crores bus costs, so three times 1 we will give 3, 4 means, I will tell you, 1.5 crore he has to bring, and 1.5 crores is our loan debt, and 0.5 crore is his contribution, that is equity. That means 25% margin party has to pay. 200 crores, 2 crores is bus cost, transport operator ko, and 3:1 we are telling debt equity. That means debt is 3, equity is 1. Equity, his contribution is 50 lakhs, our contribution is 3 times, that is 1.5. Suppose he is asking 4:1. 4:1, 200 lakhs में 4:1 means 40. 40 he says, sir, 50 मेरे पास नहीं है, only 40 I am having. If he's a good party, okay, you bring 40, I will give you 160, then debt equity ratio will become 4:1. What it indicates, this fellow is more depending on bank. Uska paisa kam, thoda kam hai, usiliye he is more depending on bank. The debt equity ratio is more. Leverage is more. Yeah, sorry. Next one. For project up to 100 lakhs, it is 4:1. Above 100 lakhs, 3:1 common. Agriculture also 3:1. Whereas for agriculture, 5.66:1 also applicable. For project up to 10 lakhs only projects. For others, it is not applicable, 5.66. And infrastructure below 5.67:1 for infrastructure. So here not 3:1, 5.6, because infrastructure is important and it is heavy amount, the leverage is given for them. And moreover, it is priority also, national priority, right? Next one, debt service coverage ratio. What is the debt service coverage ratio? You are giving term loan. We are telling every month you have to pay this much amount, but monthly that much surplus is there or not? We have to. That means the equation is that surplus divided by commitment. This is what DSCR, surplus divided by commitment towards repayment. What is surplus here? Profit after tax plus depreciation plus interest on term loan. Profit after tax plus depreciation plus interest on term loan. These are all funds available towards repayment of your term loan. That is what numerator, surplus we call. And the denominator is commitment towards repayment. What is the commitment here? Principal installment plus interest. Principal amount plus interest. This is what commitment. Okay. So term loan equation, profit after PAT plus depreciation, profit after tax plus depreciation plus interest on term loan divided by interest on term loan plus installment on term loan. This is the equation. So numerator is surplus or available funds, denominator is commitment, how much. If this is 1.5, that means if commitment is 1 lakh and available funds are 1.5 lakhs, then we call it as 1.50 DSCR. Yes, this fellow will repay. Why that margin? Your commitment is 1 lakh. You are telling 1.5 lakhs should be there. Why 0.5 lakhs extra means? If expected returns are not coming, maybe some problem like COVID problems, aisa kuch aa gaya, unexpected one. Expected returns are not coming as expected. In such cases also our repayment should not be suffered. It has to be taken care. That is why a little surplus we are asking DSCR 1.5. Commitment 1 aito DSCR 1.5 or that should be there. So this is common for all 1.5 DSCR generally. Where we can reduce here, project cost above 100 lakhs up to 1.540 we can reduce. Agricultural loans we can reduce up to 1.25. Infra also we can reduce up to 1.25. Next one is fixed assets coverage ratio. Generally, these three are asking in exam: DER, DSCR, and FACR. One question they are asking for each cadre. FACR means fixed assets coverage ratio. What is this fixed assets coverage ratio? Total fixed assets after depreciation divided by term loans availed for these fixed assets, acquiring these fixed assets. So FACR is fixed assets divided by term loans simply. Fixed assets divided by term loans. Fixed assets after depreciation you have to take, and only term loans only denominator you have to take, FACR. So what is this 1.33? Why we are telling here again 1.33 fixed assets? That means for acquiring 3 crores of fixed assets, party has to bring at least 4 crores. For acquiring 4 crores of fixed assets, we can give maximum loan up to 3 crores. For acquiring 4 crores of fixed assets, we can give loan up to 3 crores. Then it will come 4 divided by 3, 1.33. That means here margin is 25%. So fixed assets में not only our loan, party का भी है. Example बोला था ना, 4 crore में हमारा 3 crore loan and 1.1 crore उसका है. उसी लिए 4 crore is fixed assets value divided by our loan is 3 crore. So asset ratio is 1.33. This is what bank has prescribed. 25% margin इसमें आ गया. And sometimes it can be reduced margin also. Then it is 1.20 also acceptable. Right? So fixed assets coverage ratio, this they have asked the first one. 1.33, it can be reduced to 1.20. And agriculture, he has given minimum 1.2 because margin it is reduced here. Infra may be 1.11 also given because margin is very less here, right? This is about FACR. Next, repayment. Transport operator 6 years, here 7 years, 7 to 10 years, and 5 to 7. We need not worry repayment. Only this is regarding term loans, normally more than 3 years, different periods. And moratorium also will be there, term loan. Why this moratorium? Till completion of project and till commencement of commercial operations, party cannot pay repayment because there is no income. So till income generation is there, we will give moratorium or repayment holiday. Right. Next, margin. This is what party's contribution. Here up to minimum 20%. उससे ज़्यादा भी होगा. Here also 20%. And agriculture 15%. And infra it is 11% if government stake is there. Next one. IRR means internal rate of return. Internal rate of return. It is applicable for 25 crores and above. Internal rate of return. Here what this is, you are investing some amount. Say party is investing 100 crores here today. Entire this 100 crores वापस आने के लिए how much time it will take and at what percentage it will come back. Here, because period is longer, you have to take all expected inflows net asset value basis. Suppose 3 साल के बाद आपको 10 crore आना. Today 3 साल के बाद 10 crore, after 3 years 10 crore, what is its value today? That is what net present value. On net present value basis, you have to calculate at what rate our capital is coming back. This is what internal rate of return. Generally, it should be 4% above weighted average cost of funds. Average cost of funds, total funds involved here. What is the cost of funds here? Total interest on your capital return, whatever it is there, that is what average cost of funds. 4% above your cost of funds, internal rate of return should be there. Then only we will take, yes, this project is viable. If it is less than that, instead of keeping in project, borrower may go and invest in bank happily because he is getting average cost of funds. There is no margin on average cost of funds. So instead of investing in this, taking risk, I will happily invest in bank. That is what cost of funds I will get. That is why this margin should be there above your cost of funds. 4% margin, it is required for pieces above 100 lakhs and 2% in case of road projects. General clause is 4%. Since long it is there, only 2% road projects ke liye they have given leverage. This is internal rate of return, right? So these are all internal rate of return only applicable for above 25 crores finance. This simple you remember bus. These are all project parameters. For understanding purpose, I have taken a little more time because somebody asked for clarifications on this. FACR and DSCR and DER completed. Next. Interest coverage ratio. Earlier it is not given, so this year it is important for exam, for higher level only. Interest coverage ratio for specified industries or sectors, not less than 1.67 for corporates, and not less than 1.50 for MSME sector. Only ratios, please remember, it is sufficient. Interest coverage ratio. Whether your interest is covered or not out of your profits. Next, IDC, interest during construction. It is a part of project cost, interest during construction, because during construction, party may not get income. That is why whatever interest debited during construction, party may not pay. So whatever interest expected during this construction period, it is called as interest during construction. This interest during construction is also part of the project. Simply you can't tell, sir, the construction ye to 3 saal le lega. No, your project cost total for construction, everything is 50 crores only. I will give you 50 crores. So 50 crores only you are disbursing, lekin 3 saal ke liye continuously you are disbursing some amount. On this interest is calculated. Who will pay this interest? Party is investing in his margin in project. So this interest also you include under project cost. On that you fix finance. At the same time, don't finance for this IDC, interest during construction. Interest during construction should come from margin of the party. Though it is a part of project cost, it is margin to be brought from the party, not from our loan. You should not disburse loan and adjust to your interest. Party has to bring interest from his, though it is part of project cost. This is IDC. Next, minimum equity contribution by promoters shall be 50% of the overall margin. Already I have discussed this point earlier also. You are telling 25% is margin for your term loan. 25% margin. So entire 25% party may not have. He may bring outside borrowings for long term and he will give subordinate agreement. In such case, you consider them as quasi-equity and consider under loan of your margin of 25%. So how much quasi-equity permission? It should not exceed his own contribution, promoter's contribution. Margin, suppose samajh lijiye 100 crores is margin. Party has to bring minimum 50 crores from his pocket. Remaining 50 crores he may raise from outsiders as subordinated debt. Then it is acceptable. So at least equal to his contribution party has to bring. This is what minimum equity contribution from promoters should be, at least 50% of overall margin. Remaining 50% they can raise from outsiders. Subordinated agreement, what it is, in this agreement, suppose party is giving loan, long-term loan. Party is giving long-term loan and he says, I will not take back my loan amount without consent of bank, creditor. Bank is creditor. That means his loan is subordinated to our loan. After repayment of our loan only, it has to be paid as per guidelines. So this is what subordination agreement. Subordination agreement means आपका पैसा देने के बाद ही मेरा पैसा देना है वो. पहले आपका पैसा देना वो. I am agreeing. And without bank's consent, I will not take back this amount. This is what subordination agreement. In such cases, we can consider it as quasi-equity, just like promoters funds. But बाहर से लाया promoters fund. Just like our, what is our capital? Tier 1 capital में क्या बोल रहे हैं हम? Tier 1 capital में हमारा capital है and borrowed funds also there. I will tell you in the afternoon that also. Okay. Now, next, quasi-equity for term loan of 50 crore and above. I told you, no, 50% उसका पैसा होना मार्जिन में 50% बाहर से ला सकता. लेकिन subordination agreement देने के बाद भी that fellow has withdrawn some amount. And now outside borrowings are less, his equity is more, he has withdrawn already. In such case, what happens? Margin has come down because subordinated debt already has taken back. Margin has come down. In such cases, we have to charge them interest. We have to charge them extra interest if at all it is withdrawn. If quasi-equity is withdrawn later, 1% additional interest is to be charged. This is the effect of taking subordination agreement. Party को भी ये ज़्यादा पैसा पड़ेगा, so at least they will keep. बस. Next one is simple, recent one only, important at higher level. Delegation of powers while taking any fresh exposure or additional exposure under gems and jewelry sector. Normally, renewal by respective sanctioning authority will do. Any fresh exposure hai to, low risk and normal risk hai to, respected sanctioning authority can do. If it is a moderate risk, EDCAC and above authorities. It is only enough to discourage additional finance by the sanctioning authority because low risk rating people. The risk rating is not good. Okay. Next, this is also only for point for remembering because latest one. For discoms, working capital shall be restricted to 25% of total revenue. Discoms, this is na bijli wale ko, bijli again Genco Transco separate. Discoms overall even supplying grid also it will come. Sub milkar bolte discoms. In such case, if you want to finance working capital, the working capital is restricted to 25% of total revenue as per ABS. Previous balance sheet में, audited balance sheet में कितना revenue आ गया साल पूरा, how much revenue has come, total receipts, out of that up to 25% you can fix. But for small people you are telling SME के लिए 25% is capital requirement and 20% only we will give. Then for big people discounts, why 25% means because some problem they are facing, temporary problem, COVID, etc. To overcome that, a little liberal it is given. 25% you fix as working capital for discoms. And Genco and Transco, this is बिजली generation करने वाला, बिजली transmit करने वाला, electricity, Genco and Transco. For them, working capital you can go up to 50% of total revenue. Still liberal, 50% of previous year's total revenue you can go. So these two are additions recent year, important one. Next, takeover of borrowal accounts. We will discuss takeover, general norms only, not completely, because since old one, any changes are important, we will discuss. One guideline about 2-3 years back, it has come. Suppose somebody is closing loan with other bank and coming to us. If he has closed 3 mahine se zyada, more than 3 months back closed means, we consider it as fresh, not as a takeover. But now he has closed another 15 days, 1 mahine ko, 2 mahine ko hamara paas aa gaya, less than 3 months aa gaya. In such case, we consider as a takeover and takeover norms will apply. That is the guideline. Takeover ka. Next, exposure up to 100 crores takeover guidelines, rating BBB and above, good rating only we will take. And previous 3 years, they should be earning profits. Financial parameters are satisfactory. Applicable debt equity ratio, debt service coverage ratio, everything should be satisfactory. Then we will take. And previous 1 year may, it is not restructured, not SMA2, no downgradation of external rating. In such cases only, we will take. This is for takeover of account. Next, general guidelines of takeover. Only for exam point of view, whatever important, we will discuss here. The account should have been in the books of transfer book for a minimum period of 1 year. This is one. That is why for term loans, what our bank says, you bring 1 year ka par sheet and scrutinize. For working capital, 6 months ka par sheet and scrutinize. So 1 year and old. It should have satisfactory track record for at least 6 months. Second one, satisfactory track record. And DCCO at least more than 6 months back. Date of commencement of commercial operations. Commercial operations means project pura ho gaya, gestation period is over, now started commercial operations. That is date. From starting of commercial operations, 6 mahine already lapsed. So 6 months at least it should be there from DCCO for takeover. This is another. Next, shifting of account from other banks shall not be more than one occasion during last 5 years. More than one occasion. And gap to last switchover shall be minimum 1 year. Last switchover. That means more than 1 year back only that previous bank might have taken over. It is 2 years for corporates above 100 crores. Bada wale ko 2 saal pehle take over kiya hoga. Then only. And this norm is not applicable for people who have earlier remained with us and gone to some other banks because of pricing problem. Pricing means rate of interest issue mein dusra bank ho gaya. Otherwise, they are good people. So such people, this condition is exempted. Right? Next, altered financial statements for previous 2 years shall be obtained and analyzed. And in case of big corporates, it is 3 years. We have to take and analyze. Where to analyze and where to verify with ROC, we have to verify. Current ratio norms, only ratio norms for takeover they are asking. Please remember 1.33 current ratio, 1.25 for turnover people, that is acceptable. For MSME up to 1 we can accept. Current ratio up to 1 we can accept for this takeover. Next, debt equity ratio not more than 2:1. Debt equity ratio not more than 2:1. And relaxations 3:1. Normally, we are telling for fresh people, we are accepting 3:1. And in case of takeover, we are telling it should be 2:1. That means stronger. Debt should be less and his margin should be stronger. Yeah. Just 1 minute gap I will take. 1 minute only. Yes, sir. Next one, part sheet. Regarding part sheet, already I have discussed with you. That is 1 year in case of term loans and 6 months in case of working capital. It is to be verified whether regular or not. And next one, either time overrun or cost overrun, more than 15%. What is this time overrun? Party says, within 3 years, I will complete the project. But 3 saal ho gaya. Cost overrun. Total project cost is 300 crores. But for 300 crores not completed, beach mein escalation aa gaya. Some items costing more. So that variation is more than 15%. That means 300 crore project, 15% means 45 crores. 45 crores se zyada ho gaya, 350 crores, 360 crores ho gaya. In such case, we will not take over. That is what variation. It is more than 15%, no takeover. Dilution of security, we will not allow. Stock audit is generally, it is to be conducted. Whenever takeover is there, stock audit is to be conducted generally, but waiver is possible. When waiver is possible, parties up to 3 crore limit we can waive provided existing बैंक में stock audit हो गया 6 महीने से पहले, less than 6 months old. Already stock audit is over in previous bank and party has submitted that stock audit report. Our bank has given, previous bank has given that report. In such cases, we will call for previous 3 months stock statements and waive this stock audit. That is one. And suppose amount is up to 3 crores only, there also it can be waived. Here there is no, we need not call for stock audit report because stock audit is applicable for low risk 5 crores only. So here it is not applicable, but we have to obtain as per guidelines of this takeover. Here we can waive that stock audit provided previous 3 months ka stock statements party has to submit. This is waiver of stock audit at the time of takeover. Next, regarding takeover with enhancement, in such cases, it may be permitted provided collateral security available is more than 100% of the exposure, collateral security, and out of that collateral security, at least 15% in the form of commercial or residential properties. So if collateral security is more than 100%, out of again securities may at least 15% is commercial or residential properties. In such cases, we may go for additional enhancement, but enhanced portion also should cover collateral. Next, suppose if somebody is going from our bank to other bank, that means the account is taken over by some other banks from our bank. In such cases, what we have to do, whatever concessions bank has extended to that borrower during previous 1 year, we have to recover those concessions before closure, right? वो तो कोई बात चले गए तो हमसे. Next, regarding retail loans में important point is this grade, risk grade should be CRG3, that is moderate risk and above, good rating. Up to CRG3 only we will accept, number one. And prompt in previous 1 year may at least 6 months he should have been paid promptly. Then only it is eligible for takeover. Okay, not fully disbursed, projects not completed, we will not take over. Repayment, next, repayment should be restricted to original repayment. Normally, we should not expect repayment, original repayment. What happens if you expect? Reserve Bank guideline is there. Any alterations in repayment or interest, etc., it is treated as restructuring. So while taking over, if you are extending repayment period, it is deemed that it is restructured asset as per RBI. So it will become NPA. Immediately, any standard asset on restructuring, it should go to NPA. From 2015 onwards, this guideline is there. So here, no enhancement of remaining repayment period. Only exception is lease discounting proposals. Our Canara rent is there. Like that, lease discounting proposals, there only it is permitted. And that too, within maximum 180 months it is there. Within that period only it is permitted. Next, valid EMT should be created by branch within 30 days of clearance. This is another one while takeover. Next one we coming for restrictions in lending. Important points I will tell you, and remaining we will skip fast. What are the restrictions? One, advances against our own shares, no loans we should not sanction as per Section 20 of Banking Regulation Act. Next, for any company, for buyback of their shares, if they ask, no loans we should give. And this is important one, holding shares in companies here. As per Section 19, subsection 2 of Banking Regulation Act, we should not hold shares in any company more than 30% paid up capital of that company or 30% our own paid up share capital and reserves, whether as a pledgee or investor, whatever type may be. Suppose if you want to finance to Reliance company, for example, Reliance company, how much you can sanction against all shares of that Reliance company means maximum 30% of paid up share capital of that company or 30% of our paid up capital and reserves, whatever it is there, less amount, whichever is less. Isse jada we should not give. This is restriction, maximum amount, how much in it we can give. In general, more than 30% of share capital of any company's shares we should not accept as security. Bas. Where several times this question has come very, very important for exam point of view. Next one, Section 19.3. Here also the restriction is in that company, wherever one company is there, don't invest in that company shares if any of our director or MD are interested in that company. That is another guideline. Selective credit commodities means particularly your groundnut oil, essential commodities we say. Essential commodities, what government says, if you lend liberally to essential commodities, they will purchase stocks and keep in their godowns so that food items scarcity will come in market. उसीलिए liberally don't finance these essential commodities. तेल वाले को, sugar वाले को, and kapas, these are all cotton, everything they included in essential commodities. Don't lend liberally. Some restrictions you impose so that they will not keep in go downs. They will release. What they have to do, either you increase margin or you increase rate of interest. This is what selective credit commodities. So here only guideline is in case of levy sugar. Levy sugar means government rate they will fix. Even there also we are fixing 10% minimum margin, even for government rate also, because it is essential commodity. So this is regarding selective credit company. Only SEC commodity, now sugar only it is applicable at present. Next, normally we should not sanction loans against term deposits of other banks. We should not. Similarly, certificate of deposits, they are also similar to term deposits issued by financial institutions with a minimum 1 lakh rupees and 7 days minimum and maximum 1 year period tenure. These are all certificate of deposits. So against CDs also, we should not sanction loans. No loans to be granted against partly paid shares. This is also just like your that unpaid seller will have rights over your goods. Here also similar thing. So partly paid shares we should not accept as security. Next, primary security of shares and debentures we will not sanction other than individuals. That two restrictions are there. Maximum 20 lakhs already it is prescribed. So for proprietor or partnership firms, we should not sanction against primary security of shares. Restrictions are there. Next, banks should not grant advance for purchase of gold in any form. Purchase of gold ke liye nahi dena. For gold loans also, we have to accept only ornaments, not bullion or your biscuits, etc. Only exception is specially minted coins sold by banks. We can accept up to 50 grams for gold loan purpose. Except that other than bullion or gold biscuits, we should not accept. Only ornaments we will keep for gold loan purpose. And maximum 50 grams coins. Next. गवर्नमेंट वाला सरकारी वाला को अपना बिल्डिंग कंस्ट्रक्शन के लिए नहीं देना. Government for government purpose, own purpose don't give. Suppose government municipal people they are constructing housing complexes for poor people, there you can give. Banks should not extend finance for ozone depleting. This is what your refrigerators they deplete ozone substances or ACs. There some restrictions are there. Ozone depleting. Next, for purchasing Kisan Vikas Patra, NSA savings certificates, we should not sanction. This is another loan. And for not, we should not extend bridge loans against amounts receivable from central state government by way of subsidies. Some person will come, sir, I am constructing one go down in rural area where I have to get some subsidy from NABARD. I will get some 30 crores subsidy, 10 crores rupees subsidy from NABARD. Against the 10 crores, you give me 5 crores loan. That is what bridge loan. We will not give. But we will give bridge loans where we will give somebody is going for IPO, initial public offer, shares IPO. IPO certainly he will receive certain amount. So till receiving that amount against receivables, there we can sanction, but not against government subsidies receivables. Next. No loans against Indian depository receipts. What are these Indian depository receipts? Some foreign company, they want to raise finance in Indian market, share market. So instead of, they cannot directly float their shares here. What they will do, they keep some shares, abroad companies, foreign companies, they keep some shares with some depository in their country. That depository will give instructions to one depository in India. You give some bonds, that is what IDRs, which are tradable in Indian market. Against these bonds, already securities are lying in India foreign depository uske paas. So against shares of foreign company, these bonds are issued in India, which are trading in Indian market. They are called IDRs. So against IDRs also, we should not issue sanctioned loans. This is another guidelines. Next. Here variations at 3 to 4 or 4 to 5 only they may touch. Lower people, you need not worry. I will tell you for understanding briefly, within short time. Variations means we have given certain ratios, we have given term loans certain ratios we have given, and working capital certain ratios we have given. And these ratios, if somebody is coming for finance, you say debt equity ratio 3:1 is acceptable, but party is having 4:1 debt equity ratio. And DSCR we are telling 1.5, and then it can be reduced to 1.25. Party says, sir, my debt equity ratio is DSCR is 1.2 only. So here that's our variation. Each violation is one variation. Like that, they have segregated this variation. What is major variation and minor variation? Major variation means total disbursement, you have to disburse in 4 tranches. Party says, sir, I will take in 2 tranches. Okay, that is minor variation. Like that, major variations, sanction terms and conditions, minor variations. So these variations, maximum 2 only permissible for GM level, HO level only. Maximum 2 variations permissible at GM level. EDCAC, maximum 4 variations they can permit, but maximum 2 variations there also, out of 4. But some 3 major variations are there. Only 3 variations ko ED ke paas aa gaya. You are telling 4 variations ED may permit? No, because major variations more than 2 only MC of the board only, not EDCAC. So this is regarding variations. Next, credit delivery. Now even 1 to 2 to 3, all people they have to concentrate. Credit delivery, time norms for disposal of applications. Here only important one I will read, only those things please remember. Remaining you can go through also. Mostly they are asking at Kisan credit card branch powers 15 days it is coming, and MSME up to 5 lakhs they are asking. So MSME generally up to 5 lakhs 15 days, 5 to 25 lakhs aito generally 30 days norm is there. That you have to remember. Above 5 lakhs 30 days norm. Okay. And branch level I will go through for bigger loans. What is the maximum at head office level? Yes, maximum this is period. Here comes. Up to small loans again same norms only. MSME and micro small enterprise same. Export credit, fresh sanction 45 days, renewal 30 days, and ad hoc 15 days. Gold card for exporters, this frequently they are asking. Gold card, fresh aito 25 days, fresh sanction, renewal 15 days, and ad hoc sanction 7 days maximum time norms here. And this is big loans for single sole banking or consortium or JLA. Fresh sanctions ke liye or renewals ke liye 45 days, ad hoc ke liye 30 days time norms. Export credit, fresh or renewal 45 days, ad hoc ke liye 13 days. So these are time norms for disposal of applications. We will go through next one, general matters. General matters. First one is commitment charges. Commitment charges are applicable for fund-based and non-fund-based limits of 10 crores and above from bank. So cut-off limit applicability is 10 crores and above from bank. First one, fund-based. And second one, what are the maximum charges? 1% of unavailed portion is commitment charges. But there also again 1%, they have given again some leverage. What bank says is, if average utilization, this is where peak and non-peak is not given. In such cases, average utilization during the quarter, if it is more than 75%, no charges. You have sanctioned 100 crores working capital limit OCC. Party has availed 80 crores during previous quarter, so no commitment charges because it is availability is exceeding 75%. समझ लीजिए party has availed only 60 crores during previous quarter. There you have to levy 0.5% unavailed. 60 crores availed, 100 crores is sanctioned. So 40 crores ke liye 0.5% it will come. You have to charge. Unavailed portion 5.5%. Suppose Party's utilization is less than 50%. Only 40 crores only availed against sanction of your 100 crores. Then 1% commitment charges we have to charge. Suppose you have given peak and non-peak level. So up to beyond 75% वो तो avail किया तो no, less than 75% तो straight away 1%, because already you have given peak level and non-peak level. So beyond 75% unko 1% charges we will charge. This is quarterly basis we will charge. This is commitment charges. One is applicability 10 crores. Second one is 1% charges. Suppose availed more than 75%, no charges. 75 to 50% aito or 0.5%, and below 50% aito 1% charges. Next. In case of term loans, first disbursement as per the sanction does not take place within 3 months from the date of first scheduled drawdown. Here, one more thing is here. Schedule of drawdown. Term loans, what we will do? Schedule of drawdown will give, because at a time we will not disburse. Suppose somebody is constructing one industry. Industry construction ke liye 3 years or 4 years he may take. So whatever you sanctioned, immediately we will not disburse. We say first half year this much, next half year this much, next half year this much, like that we give drawdown schedule. So first half year he has to avail 50 crores, whether 50 crores availed or not. If they are not availed, then only this point will come. Okay. Term loans, first disbursement as per sanction does not take place within 3 months from the first scheduled drawdown date. Then commitment charges 1% for that amount. This is regarding term loans. So drawdown date you have to take, not entire amount. And drawdown amount only. That first installment this much, first amount is this much. So on this much amount not availed, only for this amount only you charge commitment charges, not on entire term loan. Right? Next, penal interest, QoS and HOS, quarterly operating system and half-yearly operating system. This is a monitoring tool. What is this monitoring tool? Quarterly operating system. Every quarter party has to give first my projections during ensuing quarter is like this. After completion of quarter, again he says, yeah, my achievement during previous quarter is this. This is what QoS 1 and 2. Half-yearly operating system. During previous half year, what are all the cash flows, funds flows? This is what half-yearly operating system. Party has to submit for monitoring purpose. Whether the unit is running as expected or not, we will finalize. So here, if they are not submitting in time, quarterly operating or HOS, then penal interest. When they have to submit, QoS to monitoring tools mein ab dekha hoga, QoS within 6 weeks from the end of quarter. That means March 31st ka May 14th tak dena padta. Similarly, next all quarters like that, six weeks. Whereas half-yearly operating system, 8 weeks from the end of half year. So September half year ka 8 weeks means 2 months. So September ke liye October, November 31st tak dena padta. If not given this HOS within half year, 2 months, even after 2 months also, then we go for 1% penal interest on fund-based liability and 0.25% on non-fund-based liability. Now for non-submission. Non-fund, if somebody is exclusively availing only non-fund based, not submitted this QoS, HOS, then maximum 1 lakh only we will charge, 0.25% with maximum 1 lakh cap. Somebody is availing both fund-based and non-fund based. In such case, 1% on fund-based and 0.25% on non-fund-based calculate karke collect karenge. This is what penal interest for QoS and HOS. 1% for delay in creation of EMT or second charge. Creation of EMT or second charge, 1% we will calculate. What is this 1% delay? Suppose while sanctioning itself, we says EMT is to be created by so-and-so charge, so-and-so date. Or already first charge is there some assets. Again, you are financing additional finance. So we are taking second charge. First charge is given to some other bank. Second charge we have to take. Bank is telling in sanction itself, second charge is to be created by so-and-so date. If the party is not in a position to create charge by permitted date, then we should charge 1% delay for whatever delay. Say by June end party has to create complete EMT or create second charge. June end nahi kiya, July 1st onwards, we charge 1% on liability, additional penal interest we charge. This is what delay in creation of second charge. Up to permitted level, we will not charge. Sometimes extension also concerned authorities will permit. So till that date, extended date, we will not charge. Only for extended date only, beyond extended date only, we will charge. Annual financial statements. That means audited balance sheets. Audited balance sheet and P&L account, etc. Normally, as per our guidelines, audited balance sheet is to be submitted within 7 months from the close of financial year. Our financial year is March 31st. So by 31st October, 7 months, 31st of October ko hota. So within 7 months from the close of financial year, party has to submit audited balance sheet. If they are not submitted within 7 months, then we will charge 2% penal interest on outstanding from 1st November onwards, not prior to that. 7 months already permitted. After 7 months means 1st November onwards, we will charge. Right? This is our 15 days from adoption of accounts is there. We need not worry about 15 days. This is for exam purpose. Next, enabling mechanism. Yes, penal interest cap is applicable if party is exclusively availing NAB. No fund-based limits are given to a party. Only non-fund-based limits are given. In such case, you calculate 0.25% and cap of 1 lakh. Suppose party is enjoying 1000 crores in these limits. If you calculate 0.25%, it may come to 25 lakhs or 2.5 lakhs, whatever it is. In such case, don't charge that, only 1 lakh maximum ceiling. Only if party is enjoying both working capital and term loan, in such cases, no ceiling. 1% for fund-based and 0.25% for non-fund. Right. Next, enabling mechanism for meeting payment obligations by large corporates. As per MSMED Act, what MSMED Act says is, while sanctioning loans to big corporates, 10 crores and above, working capital limits, you fix separate sublimits towards repayment to small units. What is this repayment to small units? Suppose one small SME is supplying raw material to big corporate. That big corporate may not pay to the small wala in time. In such case, the small unit will suffer working capital because usko aane wala paisa nahi aaya. Receivables not received in time from corporate. Corporate is neglecting. He cannot command that corporate because next time he may not take from him. So isko dar hai. So to avoid such unwanted situation, what MSMED Act 2006 itself they says, while fixing working capital limits to larger corporates 10 crores and above, you fix a separate sublimit towards repayment to small unit wala MSME wala ko. If the person says, sir, I am not taking any supplies from small unit wala, you ascertain and then you fix full limit without sublimit. But if he is taking from small units any raw material purchases, you fix a separate sublimit towards repayment to small unit wala. This is what called as enabling mechanism. It is applicable for working capital limits of 10 crores and above. And similarly, in MSMED Act, one more has given to protect small people. What is that mechanism? Suppose small wala supply kar rahe bada corporate ko material. Within how many days they CST have to pay? Whatever agreement is there between these two people, supplier and corporate, within that period, corporate has to pay to small SME wala. If there is no such agreement, MSMED Act says 45 days is maximum time. If within 45 days that fellow is not repaying to small SME wala, then corporate is liable to pay 3 times bank rate of interest as penalty to the small person. It is monthly compounding. This is another mechanism in MSMED Act. Okay, it is beyond this. Next, prepayment penalty for pre-closure of term loan. Pre-closure of term loan. Prepayment penalty 2% shall be collected if term loan is prepaid or taken over by. Suppose party is clearing out of his own funds, no prepayment penalty. Only if loan is taken over by other bank or financial institution, in such case only prepayment penalty will come. and it is applicable for both fixed and floating rate of interest, but it is waived in case of MSME borrowers and housing loan borrowers also. It is waived, right? And it is not applicable for floating rate term loans to individual borrowers other than business purpose. So here comes your housing loans also other than business purpose. So there it is waived, right? Next one. Revalidation bar cancellation bar sanction. Normally working capital or whatever loans we are sanctioning, party has to avail within certain period. It is called as your sanction validity period. So what is this validity period? For short-term corporate loan and corporate loan, 1 month. Earlier we have discussed this, whereas there it was mentioned as 3 months and subsequently 1 month. I told you. Working capital within 3 months party has to avail. Similarly, term loans within 6 months party has to avail. Ad hoc credit facility within 15 days, no revalidation is permitted here. Within 15 days from the date of permitting ad hoc, party has to avail. And credit facilities under consortium, normally within 6 months they have to avail. This is the guideline. If they are not availing within this period, another one extension we can do, similar period. STCL not availed in 1 month, another 1 month can be extended. Working capital within 3 months not availed, another 3 months it can be extended. Similarly, term loan 6 months it can be extended, but ad hoc it is not. For consortium, extension is there up to another 6 months. That guideline I will tell you how that guideline 6 months. Revalidation by respective sanctioning authority for the same period as above, and only once it is permitted. Consortium may, what it is guideline? Normally documentation, common documentation will be there. When joint all lenders together, common documentation is over means party has availed limits. It is implied. If party is not availed from any of the bank within 12 months, because in consortium we told you 6 months for normal sanction, another 6 months extension, so total 12 months ho gaya. Within 12 months, if party has not availed from any of the bank, member bank, then fresh sanction we have to send. Revalidation of sanction. Such cases have to be taken up for revalidation of sanction with sanctioning authority, head office. Next, in case of consortium accounts, sanctioning authority at the time of sanction may stipulate suitable validity period of 6 months. As it is there in our policy, 6 months from the date of sanction. Taking into account the probable date of financial closure. What is this financial closure again? Financial closure means tying up with financiers or lenders for full value of the project cost. Suppose project cost 1,000 crores. 1,000 crores, he has approached and 4-5 banks and arranged with all 4-5 banks 1,000 crores. We call it as financial closure because his entire project cost is already financially tied up with other. So here financial closure is not achieved within 6 months. You have sanctioned your part. Party has come out of 1,000 crores, sir, Amara loan 200 crores, bank and the bank, we have sanctioned 200 crores. And that person is approaching some other banks continuously. Up to 6 months, he could not complete his remaining 800 crores. Usme some 600 crores sanctioned, another 200 crores is due. So financial closure is not achieved within 6 months here. In such a case, another 6 months it can be extended. Financial closure is difficult. Next, duration of working capital. We have already discussed this. Irrespective of all this risk category, earlier risk category was attached. Now, irrespective of risk category, duration of working capital limits is 12 months only, excluding staff OD, GL OD, and your Kisan credit card, crop loan. This one, plus gold loan. Next, review and extension of limits. Review and extension. Other than high risk rated customers, 6 months maximum extension with tenability extension. Maximum maybe in case of genuine difficulties, party says balance sheet nahi hua, auditor is not cooperating, some data is not come, whatever it is. In such cases, we may extend. Maximum extension is up to 6 months for low risk, normal risk, and moderate risk people. And at a time, we will not give 6 months. At a time, 3 months, we will give maximum. And another 3 months. And first 3 months by concerned sanctioning authority, and the next 3 months by next higher authority, it will be given. And High risk wale ko only one time extension, that too for a period of maximum 2 months only, we will extend tenability. This is what review and extension of tenability of limits and holding on operations. Here, what is this? Normal regular accounts, you are telling yes, extension of tenability, but account is not regular. It is a standard asset, but stressed asset. Stressed assets means SMA हो गया, SMA 0 or 1 or 2 हो गया, stressed assets, or NPA account not marked for recovery. SMA 2 भी हो गया, बाद में NPA बन गया, but we have not marked for recovery. We are not sending loan card because party is good and now unit may again unit may come to normalcy shortly. थोड़ा support दिया तो, so we have not marked for recovery. And no adverse features or irregularities beyond the control of borrower. So some COVID-like situation has come. So review come holding operations, there we can permit. Here, how much time we will permit? Maximum period of 6 months, just like normal limits only. Here also, maximum 6 months only we will permit, but not more than 3 months at a time. First 3 months we will permit and next 3. And review come holding operations may main condition is that whatever liability is there at the time of permission, it should not exceed the liability in general. So beyond that, it should not grow liability, and preferably some cutoff amount also they may prescribe. What is this cutoff amount? Some credit is coming, receivables से कुछ है ना, वो संधि debtor से कुछ आ गया पैसा, उसमें पार्टी से ना रिमेनिंग ऑल वो के सर सम 10% ऑफ रिसीप्ट्स यू पकड़ो इसके लिए एनपीए के लिए, रिमेनिंग प्लीज अलाउ. So like that cut-off amount also something we will take. So liability should not go beyond accepted level at the time of holding on operations, right? Otherwise, if you stop operations in the account, what party will do? Some tax payment he has to do. ODOCC if you are not allowing, tax payment नहीं किया, वो government वाला आके उसको ताला डालेगा. It will be so. To avoid such situation, we permit holding on operations, right? Next one, rejection of credit proposals. Here also one question they are asking, particularly 1 to 2 and 2 to 3 compulsorily asking. Applications from SC ST beneficiaries customers, we should not reject at branch level. It should be rejected by next higher authority. And next one, whenever applications for loans under government sponsored schemes are rejected by branch manager, government sponsored schemes, branch manager can reject, but record in the register NB 139 or 140, whatever it is there, record in the branch sanction rejection register, so that next higher authority during their visit they will review that. And MSME rejection, concurrence of next higher authority, not by higher authority, concurrence. Rejection से पहले higher authority का concurrence लेना, सर ये reject कर सकता हूँ, ये मैं, yes, you can reject. Concurrence. Educational loan also concurrence of next higher authority, whereas export credit, branch may reject but report to MD and CEO through concerned wing. Concerned wing का मतलब, suppose if you are rejecting any SME proposal through SME wing, any agricultural proposal, agricultural exports through priority credit wing, or through any corporate normal account borrower, corporate credit wing, like that through concerned wing, you have to report to MD CEO any export credit. Next, all rejections proposals of the branch level authority shall be recorded in a register, that is a web-based NB 139 package maintained for this purpose, which shall be reviewed by the controlling authorities during their visiting to branches. Next, branches are not empowered to reject any proposals originated through Janasamarth portal. This Janasamarth portal, Ministry of Finance wala, they have started for government schemes purpose. We should not reject at branch level. It should be rejected by next higher authority. Whoever is applying government sponsored schemes through Janasamarth portal, it is to be rejected by next higher authority. Normally, if they are not entering in Janasamarth, if they are directly coming from government departments, etc., then branch can reject but record in NB 139. Right? Next, conversion of limits and exit policy. 2 issues within 3-4 minutes I will complete and then break for lunch. Conversion of limits. Two ways conversion now permitted. Olden days, only one way permission was there. Now two-way conversion, non-fund based to fund based and fund based to non-fund based. But you have to remember one thing, that this conversion of limits is mainly for acquisition of raw material purpose only. For raw material. Now we will go through once. Only letter of credit limits to advance payment guarantee for purchase of raw materials here. It is possible. May be converted to fund-based limits. Similarly, fund-based to non-fund based limits for purchasing of stocks only. And post-shipment to pre-shipment. Post-shipment means bill financing. Bill discounting is post-shipment. Pre-shipment means packing credit, CC account, your packing credit. Post-shipment to and bill finance to packing credit is not permissible here. Bill finance to packing credit is not permitted, but packing credit to bill finance, it is permitted. Pre-shipment to post-shipment is permitted. Post-shipment to pre-shipment is not permitted. That means ODOCs to bills not permitted. Bills to ODOCs is not permitted. ODOCs to bills is permitted. Bas. Similarly, secured limits not to be converted into clean limits. Next, one-way conversion of limits from LC to BG for purchase of raw material. Again, for purchase. All purposes are for purchase of raw materials only we may permit. Right? Next, exposure, credit exposure, exit policy. Exit policy is nothing but sending party out of the bank. Dealings are not good, Baba. Aapko bank se bahar jana. We will give NOC. You go and take loan from some other bank. Humse zyada ho gaya. This is what exit policy. Exit policy. Whom we will ask exit policy में किसको बाहर भेजते हैं हम exit policy में? Persisting irregularities, default in payment, etc., installments are not regular coming. This is one condition. Frequent ad hoc limits, no stock, no drawing power, etc. Failure of restructuring efforts more than twice in a period of 3 years' time. This is second condition. And in case of consortium borrowers, they are rated as high risk. Consortium. Other accounts internally rated as high risk. High risk wale ko bahar bhej denge. Willful defaulters, normally we send them out. The activity of the borrower has become uneconomical. That means incurring losses. He is not getting profits. So in such cases also we will send. But what we will tell here, we will give NOC, go and approach and any other bank or any other institution and take loan from others. We will not go for you like that. This is what exit policy. And gross managerial weakness, promoters financial indiscipline, steep downgradation in suppose low risk wala hai, low risk say normal and moderate ko gir gaya 2 notches, then also we will go for exit policy. No go rated proposals under CBPR rating. CBPR rating hai na hamara internal, usme no go rated aa gaya, then also we will go. Next one, personal guarantee of directors. Normally, in case of proprietorship or partnership, etc., we will take proprietor ka le lenge ya partnership mein, partnership mein partners ka guarantee we will take. In case of corporates, companies, main person ka we will take. Compulsory when personal guarantee. When resolution plan is envisaged, compulsorily we have to take. Resolution plan means restructuring, etc. We will take. In all loans of 5 crores and above, Aadhaar number of applicant, co-applicant and guarantor shall be obtained and updated in CBS after due verification. This is another guideline regarding main persons, co-applicant, applicant, etc. Further, exposures exceeding 5 crores, chartered accountant certified net worth statement. We have to call for every year that guarantors ka net worth statement. If exceeding 5 crores and above, we have to call for chartered accountant as certify, and we have to verify with UDIN number, verify with portal also. This is regarding expose 5 crores and above, net worth of guarantors. Next, unhedged foreign currency exposure. Unhedged foreign currency. What is this hedging of foreign currency? Somebody is importing machinery or some material, so he has to pay in foreign currency. This is what exposure to foreign currency. He may receive in 5 months, 6 months, 3 months, whatever time. So, wo aane ke baad, after import of that machinery or material, party has to pay in foreign currency. This is what exposure of foreign currency. Suppose if he is not hedging, hedging means covering through forward contracts. If he is not covering this exposure through forward contracts, 6 महीने में मिशनरी आएगा, उसको पैसा देना पड़ता. He has not covered. 6 महीने में your US dollar rate पूरा बढ़ गया. Earlier it was 75 rupees, now it is 82 rupees हो गया. Still it may go. So if he is not covered means he has to pay more amount. This is what risk is involved. He has to pay more amount. If he is covering through hedging means only premium he will pay for hedging. So say $1 lakh he has to pay after 6 months. So today he is taking cover. You pay, give me $1 lakh coverage forward contract for 6 months. I will pay the required premium. So required premium he has paid. He need not worry. Whatever rate is after 6 months, that forward contract will take care. वो payment करेगा, no problem. This is what hedging of forex. So what our guideline says, whatever our borrowers go, whatever foreign exposure is there, it is to be hedged compulsorily. How they can hedge? Two types of hedging is there. One is if natural hedging is available. What is natural hedging again? Suppose party is importing machinery or importing material, he has to pay. Similarly, party is already exporting. He has exported some goods. Usko payment आना है. वो payment में dollars में forex में आएगा. So that is already some receivable is there in foreign currency. This is what natural hedging. So $1 पेमेंट करना है 6 महीने के बाद, 6 महीने के बाद उसको बिल पेमेंट आना है $1 का. So natural hedging is there. He need not worry. 6 महीने में उसका आने वाला $1 लाख और देने वाला भी $1 लाख. It will take care. So such natural hedging is there, no problem. Otherwise, he has to hedge through forward contracts. All claims required. So this they have to give quarterly statement. They have to submit to the bank quarterly statement. What is the statement? Unhedged foreign currency exposure, whatever is there. Yes, I have to pay some $1 lakh after 6 months. This is the payment to. This is what he will give statement to the bank. It is called unhedged foreign currency statement. And for that, no hedging is natural hedging is there. So exposure. Suppose natural hedging is there, he will write yes, 1 lakh आना है, 1 lakh देना है, दोनों हो गया. This is my statement. There is no exposure to foreign currency. Unhedged foreign currency is not there. Nil he will give. So quarterly statement he has to give, and yearly chartered account certificate he has to give. If they are not giving this certificate, chartered account certificate or quarterly certificate, then we charge 1% penalty to such borrowers. Penal charges we will charge. Okay, this is what. And suppose those people who are not hedging, incremental provisioning and also capital requirements is there. Only at higher level they may ask. So I am not touching deeply this incremental criteria. Only simply one point I will tell. Exposure up to 25 crores. For them, incremental provisioning is 0.1 basis points. If they are not hedging, limits up to 25 crores. 10 standard asset ka provisioning 0.4 is the standard provisioning. What we will do here, 10 BPC means 0.1. So for them, 0.5% we charge. We keep this provisioning. This is what in case of non-hedging by small people. If the big people ke liye EBID we have to calculate and separately it will come. Up to 80 BPS and 25% risk weight it will come. And waiver of hedging, it is another one. Suppose a party is hedging minimum 25%. That means he has to pay $1 lakh after 6 months, but 25% के लिए already hedging किया, $25,000 के लिए hedging किया. Party is low risk 1, LR2 party, no problem. We can waive hedging. Or LR3 party, at least 50% hedging किया, okay, permissible. Remaining, we will waive. So this is what for waiver, minimum 25% hedging for AAA rated people and minimum 50% hedging is required for AA rated. In such case, waiver will do. Otherwise, if they are not, means 1% penal we will charge. This is what hedging purpose. Okay. Next, legal audit onwards, we go for lunch. Now we will break for lunch and 45 minutes. I will give 45 minutes time lunch break. We will assemble after 45 minutes lunch. LUNCH lunch break. अभी 125 हो गया. 125 से 45 minutes. 1.25 PM to 125 plus 45 minutes, 2:10. Yeah, 2:10.
Sir, good afternoon.
Yes, sir. Yes, sir.
Sir, what we can do is we
Ah.
will close this session so that recording will happen.
Okay, sir.
You can announce what you are going to handle in the afternoon session.
Yes, sir. So here, sir, still leftover is there, sir. Afterwards, in leftover ke baad, what I will do is, one is RBI policies. I will cover first because RBI policies, maximum 20 minutes or half an hour I will take, important for exam. Changes of RBI policies in 2022. Uske baad I will cover basal. If still time permits, then I will touch balance sheet, sir. Lastly. Or anybody wants prior to balance sheet early hai to bhi, that also I can cover. So these three aspects today I have kept for this session, afternoon session. One is RBI notification, second one is basal, and third one is balance sheet. These three issues. But still, sir, another half an hour or 45 minutes, this policy is left over, sir.
Okay,
Right,
sir. So post lunch session, please, friends, we will now close this session.
Yeah.
You can rejoin. We have already given a link. With that
Yes.
link, you can rejoin fresh. We will end this session. Sir, in the
Yes.
meanwhile, there were 2 questions asked by the participants.
Yes, sir.
You can note down and reply later also, sir.
Yeah. इसमें नहीं आया, sir. That questions please tell. I will clarify, sir.
One is, what is subordinate agreement?
Yeah, subordinate agreement already I have explained, sir. Unko subordinate agreement means the party may take loan from outside borrowings, outside borrowings. That who has given outside borrowings jo diya na, that people will give agreement to the bank stating that we will not withdraw the amount without consent of the bank. That is what subordination agreement. Or if you take that subordination agreement, it is treated as quasi equity. That is one subordination agreement.
Another question is, penal interest cap of rupees 1 lakh is only for NFB.
Yeah. That also I clarified. I have seen and clarified. Yes, exclusive non-fund based wale ko maximum 1 lakh only. Beyond that, we will not charge. Suppose if they are enjoying both fund based and non-fund based, then no 1 lakh ceiling, sir. It is both same. That means 1% for fund based and 0.25 for non-fund based without any ceiling.
And
exclusive NFB hai to 1 lakh ceiling.
Now
Yes.
the latest question is, interest coverage ratio is not there in note.
Yes, sir. Interest coverage ratio, it is recently it is given. That is why interest coverage ratio in 2 ratios they have given, the 2 for SME and non-SME. That only I have mentioned. Only ratios, please note. And remaining, if you want anything, afternoon balance sheet, that I will cover.
Okay, sir. With this, we will wind up this session.
Sure, sir.
And we will join fresh, sir. You are also have to join with the new link, sir.
Sure, sir.
Link is the same link. But we will close this session and we will rejoin with the new links.
Sure, sir.
Thank you, sir.
Thank you, sir. Thank you. I will also close in that case.
Yeah.
Okay. Yes, madam. अभी मैं जा रहा हूँ मैडम, खाना खा के।